All right. A very good morning, and welcome to this auspicious occasion, the Genghis Playbook 2021 conference. I hope from wherever you are, you're keeping safe, especially during this season. I want to start on a lovely note on a quote, courtesy of Matters Investments, that says this, that an investment in knowledge pays the best interest. An investment in knowledge pays the best interest. Simply put, that you cannot afford to be out on the know when it comes to matters investment. And this conference is purely geared towards those matters on the playbook that we are about to get, courtesy of Genghis Capital. Our theme on this conference is navigating the now normal. I know it sounds like a typo, but this is the now normal that we have. So our theme is navigating the now normal. Of course, getting to understand the predictions so that we can make better informed decisions when it comes to matters investing. And we shall be having a lot of discussions today lined up based on matters macroeconomics, fixed incomes, and matters equities as well. And just to inform you that we are as well having this particular conference live on YouTube. And so if you visit Genghis Capital YouTube page, you're going to have this event being streamed live. And for those of you who at least are quite tech savvy, which we are, at least most of us, we are also going to be having this conversation going on Twitter. And our hashtag for the day is Genghis Playbook 2021. I want to repeat that hashtag again, Genghis Playbook 2021. And of course, I know there's a lot that can be said about 2020, the events, most of them which are described as unprecedented. But what does 2021 hold in store? I hope and pray that at least the playbook will give us an enlightenment of a hope for 2021. So at this moment, just to let you know that we're going to have this session between 8 and 12 o'clock. So I don't want you to go in any way because there's interesting conversations going on from our keynote speakers, as well as amazing panel discussions that will enlighten you to make informed decisions. My name is Maina Shege, or if you like, you can call me MC. I'm your host today. So at this moment, I want to request our CEO, Geoffrey Gangla, the CEO Genghis Capital, who is going to open the session with his address. Bwana Geoffrey Gangla, karibu sana Gangla.
Thank you very much, Mina. And let me start by recognizing our guests today. We have Mr. Albert Mwenda, the Acting Director General, Budget, Fiscal and Economic Affairs, National Treasury, representing the Principal Secretary. Mr. Kiprono Kitonyi, the Chairman of the Nairobi Stock Securities Exchange. Mr. Godwin Wangongu, the Chairman, Genghis Capital. All our invited panelists, ladies and gentlemen, good morning. It is my pleasure to welcome every one of you to this event as we launch the 2021 Genghis Playbook. I sincerely thank you for finding time to be with us today. Genghis Capital is a leading investment bank, and we provide services that range from securities trading, corporate finance, and asset management. At Genghis, we believe in integrity, professionalism, value addition, and long-term partnerships as our core values. And this has enabled us maintain a leading position in the sector. I'm delighted that quite a number of our clients have been able to join us this morning. And while traditionally this has mainly been for people who are based only in Nairobi, we have a mix of clients from other jurisdictions, and acknowledge that some of them, the time zones may be off, but they've managed to join us this morning. So we're very pleased by that commitment to the firm and to this engagement. Ladies and gentlemen, the past year was undoubtedly the most challenging in recent history. The magnitude and speed of collapse in the economic activities as a result of the COVID-19 pandemic was unprecedented. The initial economic shock was deep and profound, and what made it worse was the uncertainty surrounding the situation, that during the time as little was known about the virus. A lot therefore depended on the effectiveness of the containment measures and the development of therapeutics and vaccines, all of which were hard to predict for most of the past year. We acknowledge that the government did provide unprecedented support to households, firms, and financial markets during the year. And while this has been a crucial step for economic recovery, there was still considerable uncertainty about what the economic landscape will look like post-pandemic. Up until now, the global economy, including our own, is facing uncertainty as the evolution of the virus continues to weigh heavily on the economic outlook. This is as the continued spread and reports of different virus strains continue to worsen uh, the situation. However, in as much as there's a lot of concerns about the rapid spread and reports of the new strains, we anticipate that 2021 will be a better year economic-wise. The development of vaccines and the subsequent rollout in different parts of the world and the planned rollout even in Kenya gives us hope for the year. We anticipate that the economy will continue with the recovery process, albeit slowly, and there will also be significant investment opportunities in different sectors throughout the year. I think despite, and you'll agree with me, despite all the negative news, and even though markets seemed to have dipped, there were still a number of areas which offered pockets of attractive value to clients. And it hasn't been an all doom and gloom story. Uh, Looking at the Playbook 2021, I'm quite excited about the work that our research team, led by Churchill Ogutu, has done over the year. And we are all looking forward to their input into what the outlook for 2021 will be. I'm sure they have a number of compelling investment ideas, which, if followed, will be able to yield attractive returns to the investors. The team is now ready to unveil the Genghis Playbook 2021 that will look at various aspects of the economy, providing valuable insights into the investment opportunities. I'm looking forward to this day and to engagement from all the parties involved. And we also have a heavyweight panel of speakers and panelists who will also weigh in on this uh, approach. And this time, we've done the playbook differently. Normally, it's just our team that gets to present, but based on the feedback we've received from clients, we felt it wise to invite a number of market practitioners to come in and also share their own insights with our clients. And for that, we are very, very grateful. I'm looking forward to the rest of the conference, and let's keep engaging and keep investing through Genghis Capital. With those comments, thank you very much.
Thank you so much, indeed, our CEO, Geoffrey Gangler. And of course, I agree with you that we can't wait to hear the predictions that will be here for this particular year. There's nothing as good as that. I met a young man who was saying if there was a way God would just predict and say, this is the lady you should marry. And so we are looking at this and say, we want to know the wise and, tap on the wise wisdom of the research analysts so that at least we can become better investors, especially this year, hoping you're not going to predict there'll be another corona season. Anyway, at this moment, I want to have the pleasure of inviting
Mr. Distinguished ladies and gentlemen, good morning. It gives me great pleasure to extend to you all, on behalf of Genghis Capital, our deepest appreciation for joining us this morning to launch the Genghis Playbook 2021. When we were launching the playbook for the previous year, just like many other people around the world, we never foresaw a global pandemic that would have so much effect and end up disrupting virtually every aspect of our lives. The COVID-19 crisis disrupted almost all aspects of the economy, and as such, most of the predictions on the economic outlook for the past year did not come to pass. Most of the industries that drive our economy were adversely affected, which led the economy into a nosedive. We are, however, in a different situation currently as we enter 2021, lights at the end of the tunnel. The arrival of vaccines will hopefully mean a swift reopening of many sectors of the economy. However, the economic rebound is unlikely to arrive as fast. But we believe an end to the pandemic and policy support from the government will continue and contribute a brighter future for our economy. Our 2021 Genghis Playbook assesses the post-coronavirus period, what we call the now normal, not the new normal, but the now normal, as opposed to what many refer to as the new normal. What it will look like and the outlines of the possible investment implications and opportunities are what we'll be looking at. The playbook assesses the key drivers to economic growth and recovery process, as well as the risks that are likely to derail the process. As you may all be aware, apart from the coronavirus pandemic, 2021 is largely going to be a highly political year, with expected Building Bridges initiatives or BBI constitutional amendments referendum and the 2022 general election politics set to dominate the year. These are some of the factors that the playbook gives insights to and how they will affect the country's economic outlook. The Genghis playbook also gives an outlook of the key macroeconomic variables and assesses how each variable is likely to affect the year's economic outlook. In addition, the playbook also gives our expectation of fiscal policy and monetary policy developments. We understand that following the pandemic, the government swung into action to undertake both fiscal and monetary measures to protect both the economy and the citizens. While some of the measures taken have since reversed, some are still in place, and therefore the playbook, through the playbook, we try to predict new development in this regard. The playbook also looks into the country's public debt status and the resultant investment opportunity through fixed income assets. As we would all understand, the COVID-19 pandemic has had adverse effects on the government earnings. And with little revenue streams available, the government is compelled to borrow in order to sustain its operations. Therefore, we interrogate what this means for the country's economy, while also offering insights of the available investment opportunities as a result. Aside from the macroeconomic outlook, ladies and gentlemen, the Genghis playbook also delves into the equities markets, offering insights on the factors that are likely to influence the market's performance and generally the outlook for equities in the year. There are also investment opportunities highlighted with specific stock and portfolio recommendations, as we also give a general review of the year's capital markets and our predictions for the current year. Ladies and gentlemen, these are just some of the things that we have covered in this year's playbook, which we hope will be of great importance for all players. At this point, I wish to say that as Genghis Capital, we are honored to be hosting this special conference at the beginning of the year. I call it special because this is the first time that we're hosting it virtually and with external speakers and panelists. It's such a great honor to have you all here today. Special mention goes to Director Dalacha Barako and Mr. Kiprono Kitonyi for honoring our invitation. As major players in this whole conversation, your presence and contribution today is highly valuable, and we appreciate that. I also acknowledge and appreciate that all the panelists present here today and online as well, and I look forward to engaging and very eye-opening discussions. The Genghis Playbook Conference will have a unique look at the retail investor segment, which we anticipate will experience significant growth during the year. This segment is a very important space for us at Genghis, and we hope that all participants will find the discussions insightful. I also recognize my fellow board members, Dr. Joshua Aroni and Diana Ishaga, who play a pivotal role in shaping Genghis as a client-centric company. As Genghis Capital, our aim is to position ourselves as thought leaders, and that for us involves getting diverse perspectives from different quarters of the financial market space. Your presence today is therefore one that we cherish and appreciate. Finally, ladies and gentlemen, I once again welcome all of you today to today's conference and wish all of you fruitful discussions. Thank you very much.
Thank you, Chairman, and we appreciate your remarks on that. And just a quick reminder, this is the Genghis Playbook 2021 conference, in case you just joined in. And we are live as well on YouTube on Genghis Capital YouTube channel. And in case you also want to engage in the conversation on Twitter, our hashtag is Genghis Playbook 2021. Please feel free to send in your comments, questions, anything, and we are responding to all those live as well. At this moment, I want to invite our keynote presentation on macroeconomic developments, and the person presenting on behalf is Dulacha G. Barako, Director National Treasury.
Thank you very much, Geoffrey. Can you hear me?
Yes, we can. Please go ahead.
Okay, thank you. As you rightly said, I'm representing PS Dr. Julius Muya. I am Dulacha Galgalo Barako, Director at National Treasury, Department of Financial and Sector Affairs. And I want to make his remarks for this virtual conference. Mr. Kiprono Kitonyi, Chairman, Nairobi Securities Exchange, Mr. Geoffrey Odundo, CEO, Nairobi Securities Exchange, Mr. Gordon Wangovu, Chairman, Genghis Capital, Mr. Geoffrey Gangula, Chief Executive Officer, Genghis Capital, Mr. Jared Osoro, Director, FSD Africa, heads of other institutions represented, distinguished guests, ladies and gentlemen, good morning. It is my pleasure to join you today in this workshop to direct on the Genghis 2021 Playbook. I am grateful to the management of Genghis Capital for preparing this insightful research publication and also hosting this event. As key stakeholders in the capital markets industry, we appreciate your presence today. Let me begin by saying that the theme of this year's Playbook is timely as we navigate the new normal occasioned by the outbreak of novel coronavirus COVID-19 pandemic, which has devastated the global economy. Kenya has not been spared of the negative impact of the pandemic. The pandemic and the resultant containment measures have not only disrupted the normal life and livelihoods, but also to a great extent business and economic activities. As a result, our economy contracted by 5.7% in the second quarter of 2020, compared to 4.9% growth in the first quarter of 2020, mainly recorded in the service industry and other subsectors. In particular, accommodation and food services, education and transportation, and the storage subsector were worst hit. On the positive side, agriculture remained strong, thanks to above average rainfall. Beyond second quarter, economic activity is showing signs of recovery in the third and fourth quarter, October to date, following the opening of the economy, but with pickup is weak. The growth outlook for 2020 has been revised to 0.6 in 2020, 6.4 in 2021, and 6.1 in 2024. The stable market environment, ongoing investment in strategic priorities of the government under the Big Four agenda, the economic stimulus program being implemented, and the planned post-COVID-19 economic recovery strategy turn around in trade as economies recover from COVID-19 pandemic, and the expected favorable weather that will support agriculture output is expected to support growth. Sorry, I'll put on the camera. I'll go back to the last point. The growth outlook for 2020 has been revised to 0.6% in 2020, 6.4 in 2021, and 6.1 in 2024. The stable macroeconomic environment, ongoing investment in strategic priorities of the government under the Big Four agenda, the economic stimulus program being implemented, and the planned post-COVID-19 economic recovery strategy turn around in trade as economies recover from COVID-19 pandemic, and the expected favorable weather that will support agricultural output is expected to support growth. In May 2020, the government rolled out an 8-point economic stimulus program to cushion citizens and businesses, protect livelihood, and stimulate the economy. The focus of the ESP is to improve infrastructure and urban renewal, improve educational outcomes, enhancing liquidity to businesses, including MSME, improving health outcomes, agriculture and food security, supporting tourism recovery, improving the environment, supporting manufacturing, and enhancing social protection. Ladies and gentlemen, we are finalizing an elaborate post-COVID-19 economic recovery strategy 2020 to 2022, which will reposition the economy on a steady and sustainable growth trajectory. The ERS will build on the earlier government initiative to protect lives, support jobs, and the economy. The ERS will prioritize 6 social sectors to improve livelihood and facilitate renewed growth of the economy. These include healthcare, education, water, and sanitation, social safety, net programs or conservation of water towers, and investment in labor and employment sector. On budget implementation, we have continued to experience revenue shortfalls and rising expenditure pressures. The shortfalls in revenues reflect the weak business environment and the tax relief implemented in April 2020 when COVID-19 struck. As the economy reopens, we expect this trend to reverse. Already tax relief have been reversed beginning January 2021 back to their initial levels. In this case, corporate and pay rates will revert to 30% from 25% and VAT to 16% from 14%. In addition, we'll continue to engage creditor nations and multilateral institutions to secure debt servicing moratorium and debt cancellation to free up resources and provide necessary budget flexibility. We have also finalized public debt and borrowing policy, which was launched in March 2020. The next phase will involve dissemination, which has been delayed by the pandemic. In addition, discussions with IMF for new facility are ongoing, and we are working on to agree on a final position. As outlined in our current blueprint Vision 2030, the government of Kenya aims to create a robust, inclusive, efficient, stable, and globally competitive financial services sector that promotes saving mobilization to finance long-term development. Modernization of capital markets industry, therefore, is at the center of government's economic agenda, whose aim is to create an enabling environment that provides citizens with the opportunity to participate in the economic development and improve their socio-economic well-being. Ladies and gentlemen, the key flagship project is still making Nairobi an international financial hub. We are fast-tracking operation of Nairobi International Financial Center, This will create a framework that enables accelerated investment in the Kenya financial sector as well as in other sectors of the economy. In addition, we are also on course with the implementation of the Capital Market Master Plan 2014 to 2023, which is a crucial guide in the effort to deepen our capital markets. The master plan is second on three pillars, namely supporting domestic economic development and transformation, the infrastructure of the markets, and strengthening the legal and regulatory framework. Our short-term vision is, in response to COVID-19, is to drive Kenya's overall economic recovery and restore growth through deeper and sustainable capital markets. Through innovation and responsive policy and regulatory interventions, we need to centrally position the Kenyan capital market to support rapid post-COVID-19 economic recovery through smart policy and regulation that enhances access to long-term capital and investment by diverse stakeholders and sustain existing stakeholder business. Therefore, government will adopt a macroeconomic framework to drive renewed growth based on reforms in the monetary policy and the financial sector, fiscal policy, public debt restructuring, and public-private partnership. In particular, we'll continue to monitor the economic situation and take appropriate measures in consultation with the financial sector regulators to safeguard the health of the financial sector, and in particular, the capital markets. In conclusion, we are of the view that the dislocation in the economic landscape and spillover effect on the investment environment will ease eventually, though with lag. That said, Genghis 2021 playbook will address themes in our view are less transitory and offer investment perspective with our outlook for the year and how investors can better navigate them, the risk notwithstanding. I assure you of the government's unwavering support in creating an enabling environment for all industry players to optimize their contribution as we navigate the new normal in the aftermath of the unprecedented crisis that was salient throughout 2020. With these few remarks, ladies and gentlemen, once again, thank you for taking some time out of your busy schedules to participate in this conference, and I look forward to fruitful deliberation. Thank you. Thank you very much. Those are remarks of our PS, Dr. Julius Muya, PS National Treasurer. Thank you very much, members. Thank you.
Thank you so much to you as well, Dulacha Barako, for the representation and the assuring remarks. We surely look forward to an amazing year. But this can only be said better now as well by our in-house, well-abled research analysts. And the head of research analyst is right here next to me to come and make the presentation on the Genghis Playbook 2021 Macroeconomics and Fixed Income in-house views. I can't wait for this moment. So at this moment, please help me welcome Churchill Ogutu, head of research, Genghis Capital, to come and give this presentation.
Thank you, Maina Chege, for that wonderful introduction. And thank you, Professor Walako, for your keynote presentation on behalf of the PS National Treasury. I'll take you through the macroeconomics. Just a second. I'll take you through our macroeconomics and fixed income outlook, our views. I'll start with the global growth outlook. That is expected at 4%. This is from the latest World Bank reports. The key themes that will dominate in the year is now the rollout of COVID-19 vaccination across the globe. There are a number of developments that is coming from that front. There are also the fiscal and monetary stimulus policies that are already in place. We expect that still to be in place. And also the geopolitical developments from the US. We expect a new administration. Tomorrow, Joe Biden is being sworn in as the next president of US, and there could be some new developments that will come from the US. In Europe, we are seeing Brexit. So those are the key geopolitical developments. For Kenya, we've had Treasury for their growth outlook this year is around 6.4%. Ours is a bit lower, 5%, but nonetheless, we are seeing some base effects coming off from a pandemic ravaged year last year from estimate of 0.6% from Treasury. Some of them are even below 0%, but we are seeing that last year was a worse year. But that being the case, there's that base effect that this year there could be a bounce back. So our estimate is around 5%, about. So from a demand perspective to the GDP, we are seeing that consumption, that recovery will be there, but with a lag. We're seeing unemployment is elevated at around 7.4%. That is the latest statistics we have. And comparing to pre-pandemic levels of around 5.3% average of 2019, we are seeing that there's still some lag from the labor segment. Services sector, that is the area that you are seeing is bearing the major brunt of COVID-19 fallout, be it tourism, education, though education has started to recover slowly, and also the trade segment because of the reduced income from individuals. So we are seeing that services sector, which previously used to be the segment that used to supply, there's some progress with the COVID-19 vaccine. We are seeing that there's still that risk of multi-waves of infections, be it second wave, third wave, and also mutations. There are various parts of the globe that are having new strains of the COVID-19. So that poses a major risk on the recovery. Of course, domestically, political noise has started rearing its head, and it could dampen business investment going forward, in particular this year. Moving on to some of the macroeconomic variables that we are looking at. In terms of inflation, we expect it to remain anchored. Our baseline estimate is around 7% throughout this year. Last year, closer at 5.6%. The fourth quarter, in particular, we saw it starting to pick up. We expect it to continue the same. The reversal of VAT at the beginning of this year back to 16% will have some inflationary pressures. That's on the headline numbers. But that said, on the core inflation, we expect it to remain muted because of the uncertainty that are still remaining in the economy, and that will still subdue core inflation below 3% levels in our view. Fuel inflation also is expected to remain steady. There was an announcement that came from OPEC and its allied nations at the start of the year, which we, in our view, will steady the prices of oil in the year. Moving on to the other variable that's on the currency. Last year, it weakened 7.2% against the dollar. We still expect that there could be some further weakening bias in the year. It touched lows of 111 last year. But we still expect the weakening bias still to remain with us. Right now, last year, imports was subdued vis-a-vis the previous years. But as the economy starts to gradually open up, there could be a steady recovery in import growth, and that will have some pressure on the Kenya shilling. And of course, the external debt payments, that's the pressure point on the Kenya shilling. That said, we are seeing support of the Kenya shillings in the short term. We expect some inflows from the international financial institutions, that's the World Bank, IMF, African Development Bank, which will be supportive of FX reserves and ultimately on the Kenya shilling, at least in the short term. Going to the public finance, and that is one of the areas that is quite key in our economy. The revenue, we expect the tax adjustments that were made at the beginning of the year. That's the reversal of the VAT back to 16%, corporate income tax back to 30%, and also the upper income band that tax for that back to 30% will also have an impact on revenue. That said, that's where we are seeing the targets for revenue will go up from 1.6 trillion that is currently in place as per the latest figures we have. On the expenditure side, we're expecting a supplementary budget one sometime probably by the end of this quarter. That had already been preempted with the budget review outlook paper that was out there in October, but that figure was around 105 billion from the calculations we did. But we are seeing that there could be some changes based on even the post-COVID-19 economic recovery strategy that even Professor Walako has attributed, as alluded to in his keynote remarks. So we are seeing that we're expecting that supplementary budget at least to, it will make some changes on the government expenditure. And of course, this also comes back to the financing that you expect. Right now, based on the budget review outlook paper that came out late October, we were at 1 trillion shillings. So this is subject to change just based on the revenue adjustments and also the expenditure that we are keen on seeing from the supplementary budget one estimates. And now that takes us to public debt from the financing. From the baseline scenario, we expect it at 7.7 trillion by the end of June, but that is still subject to change based on the changes that will occur as a result of the supplementary budget that we expect. At 7.7 trillion in our baseline scenario, that represents 68.3%. Again, that is subject to changes in the event that nominal GDP does not perform as per. In regards to the flows, last week we saw the debt service suspension initiative from 10 Paris Club creditor nations. That resulted in a reprieve of 32.9 billion in external debt service. That's around 9.8% of the total external debt service that was to be made in the course of this financial year. Of course, there's talks of a further 40.6 billion from non-Paris bilateral creditor nations, and that will have some impact on that. So ideally, just looking at the interest debt service costs as a percentage of ordinary revenue in the current financial year, we are looking at north of 30% of the ordinary revenue now catering servicing of the interest debt costs. That, of course, means that there could be some pressure in terms of now even development spending and even some of the recurrent expenditure, be it operations and maintenance. Recent developments coming from in regards to public debt is now the bill that was tabled, Public Debt Management Bill. This bill seeks to at least elevate public debt management into an authority, which will also be able to dictate even the levels of the debt that can be incurred any given year. It's a positive step, but it's subject to legislative process. So we are really keen on seeing how this will also pan out in the course of this financial year. In regards to monetary policy, last year we saw slash on the central bank rate. Initially, when we started the year, we were around 8.75%. There was a cut in January. And of course, with COVID-19, we saw another 1.25%, a slash in the central bank rates. So right now we are 7%. We still expect it to remain there at 7%. Looking at some of the indicators attended to CBR, that the first one is private sector credit growth. The latest data we have as at November, we are at 8.2%. But now drilling down into the data, we're not seeing that there's been robust credit mediation to the private sector. So that means that there could be a wait and see approach by the policymakers, that's the MPC, just to see how it filters through. And also there could also be the output gap, negative output gap, which means that we are punching below our weight in terms of GDP numbers. So that will invite wait and see approach by the CBK MPC meeting. Of course, we are looking at some cost push inflationary measures coming from the VAT. but that that will invite a neutral policy stance by the policymakers. No amount of cost push or pressure might be cured by an accommodative monetary stance, meaning that in the event that inflation flares up from a cost push perspective, we are saying that that will just be a neutral monetary stance. So in our baseline, we are seeing a CBR rate at 7% this year. Moving on to all this now ties into the fixed income asset class. Genghis, we also deal with bonds and T-bills. So in terms of our outlook, there are some elevated maturities, at least in this in this first quarter, as compared to the average of the quarters last year. We are seeing close to over 400 billion in maturities, T-bills, T-bonds. So that will support liquidity, the demand from the investors, and the next point, we also expect net domestic borrowing to be revised. Initially, when we started the budget year, we were at 494 billion. That was revised upwards 600 billion as per the budget review outlook paper. But because of these changes, there's an expected increase in revenues. There's also the savings that is coming from the debt service suspension initiative, and also the revision in the spending. So that means that the net domestic borrowing will perhaps be revised lower. We also are seeing a new facility from the IMF, which was not even priced in the initial budget. So all this tying all these things together, we are saying that there's a likelihood that net domestic borrowing will be revised lower from that elevated amount, 600 billion. We expect that now the yield curve, that this is basically the pricing of the bonds for all the tenors from the 91-day T-bill up until the 23-year T-bond. We expect that the prices of those papers to rise slightly up 0.1%, or in jargon, 10 bips uptick. That will also be in tandem with the headline inflation that we expect to play at least in this first quarter period. So in terms of a recommendation, there's high demand for short-term papers just because of the uncertainty that is still engulfing the economy. So that part of the yield curve, anything between 5 years and below, is quite crowded and is expensive. So we are recommending investors to look at the next best place, and that's the medium-term part of the yield curve. This is anything between 5 years to 10 years, which is, there are some opportunities that now investors can also tap into as they weigh the economic environment as it plays out. Finally, we also have our fixed income model portfolio. This is a national portfolio that we've been tracking over the years. Last year, unfortunately, it trailed the benchmark, that's the FTSE NSE bond index. So we have categorized them into three portfolios. The first one is now the core income bonds. This is bonds that have maturities below 5 years. The next one is now aggressive income bonds. These are now the portfolios that have at least higher coupon rates. And now the trading bonds are the ones that majorly are the infrastructure bonds, which are now, the appeal is now the tax-free appeal that they do have. So in our outlook, we are seeing that it will have an expected total return of 11.05% on the portfolio. So that's it from my end. Back to the MC now to guide us to the next session.
All right. Thank you so much, Churchill. That was quite detailed on how we are looking forward on the macroeconomic 2021. Thank you so much for that. And before I want Churchill not to leave the desk because he's going to farm this up as well with a discussion that we are looking forward to have. But before we do that, just to remind you that all your questions will be answered when you send them, especially for the ones who are joining us through the webinar and also the ones who are joining us on social media. Please feel free to send all your questions. I've just been informed by the research team that there will be a comprehensive document to answer all those particular questions that will be sent to you along with the playbook. So keep them coming because they will be answered. But for now, in this particular discussion that we're about to head to, please feel free to send in whatever questions you may have to the panelists because they will be answering them as well live. So right now at this moment, I want to request again Churchill Ogutu, who is going to moderate this particular session with the Director FSD Africa, Jared Osoro, and they will be having this discussion on Kenya's macroeconomic outlook for 2021. That's the panel discussion that we're about to have right away. So over to you, back to you, Churchill, for this particular discussion, and Jared Osoro as well.
Thank you, Maina Chege. We now move to the panel discussion on the macroeconomic and macroeconomic developments. So joining me this morning, we have Jared Osoro, and we also have Professor Barako, but I understand that he'll be leaving us shortly into another engagement. So I'll also be joined by our CEO, Mr. Geoffrey Gangler, just to look at the macroeconomic landscape this year. So Jared, as I welcome you into this panel discussion, perhaps you can start with giving us an overview. What's your expectation of 2021?
Yeah, thank you, Churchill, and thanks to Genghis Capital for the invitation to be part of this conversation. I think 2021 will obviously be different from 2020. That's for sure. And that is because there's an obvious sense of optimism. We are seeing a slow resumption of economic activity, which speaks to a gradual return to normalcy. I know you're calling it the now normal, but I see a very slow return to normalcy as we see economic activity picking. To my mind, the popular perspective of forming the outlook for this year and for the medium term has obviously been really looking at how the economy plays out vis-a-vis where it was pre the pandemic period. Of course, the embedded assumption in there is that you had what you can call ideal initial conditions at that point in time before the pandemic. But if you start looking at those conditions, then yeah, you probably have to imagine that we had an economy that was setting itself towards embarking on a fiscal consolidation, because at that point in time, before the pandemic, we're looking at a situation where the fiscal policy was looking at a situation where it was more or less getting out of balance. At the same time, we went into this pandemic where we had, of course, a sense of stability across the markets, be it the financial markets, goods and services, and the foreign exchange market. But on the back of that, we had started seeing a challenge insofar as the quality of assets that were being held by a big chunk of the financial system, especially the banking industry. So if that's the platform around which you're going to form your expectations going forward, then you have to be very careful insofar as you relate the interplay between the domestic economy and the external economy. I know that agencies such as the World Bank, in its global economic perspective recently published, has indicated that there will be a rebound, more or less, of the global economy to grow as far as 4.5%. But that has to be seen in the context of how it relates to the local economic dynamics. To what extent does that lead to our external balances behaving in a manner that will support stability of the foreign exchange market? All that relates to the policy space where we find ourselves in. To me, the dilemma that we have to navigate is really the policy imbalances that we are seeing. When you have a pandemic and an economic slowdown like one that we experienced last year, ideally the policy should be counter-cyclical, meaning that you start pushing up fiscal policy and monetary policy to remain accommodative. To what extent is fiscal policy being counter-cyclical right now is a question that we need to ask ourselves. So taking all that in totality, I honestly see the economy growing at a slower rate than both the official figure that Professor Balako gave and the view that Genghis gave of 5%. And I say so because if you look at the past 10 years, our average rate has actually barely been 5.5% on an annual basis. So amidst the pandemic that actually made the economy shrink and the slow recovery that we're expecting, I see, of course, a positive rate of growth, but certainly less than 5% that you're looking at as your pessimistic case. So that's really how I see the economy playing out this year. But I think with an opportunity for the economy now springing back gradually into an average rate of about 5.5 going towards the medium term. So that's really how I see things playing out this year and going forward. Thank you.
Thanks, Jared, for those initial sentiments. I would like to invite our CEO just to give his perspectives from a private sector, perspective. How do you see the macroeconomic landscape even last year and also getting into this year?
Thank you, Churchill. I think last year was extremely challenging for many businesses because of numerous disruptions. If you look at, we boast of an economy which is well diversified, services, agriculture, tourism, trade, and the like. But if you look, some of the key pillars of the economy were significantly impacted, and I think that's what led to the slowdown. It's amazing. We thought we'd probably see negative GDP growth, which didn't happen. I think even then you're looking at just slightly above, maybe 0.5% for the year. But overall, given that challenging economic environment and the disruption, if you look at areas like private sector credit growth, where a lot of businesses and banks had to just restructure their loan portfolios because there was just not enough commerce, then it portrays a very tough environment. Then you look at the tax collections. Very interesting that we met the target for December, but I think the earlier part of the fiscal year, July to September, it was very, very challenging. So there's certainly a big liquidity crunch, and now I've also seen the IMF has requested that we recompute the debt figure to include what sits in the parastatals and guarantees and the like. So if you just look at it from that sort of macro perspective, it shows a very tough environment. And I think the reason why probably we had some growth and inflation was muted was because of overall fuel prices were contained, and food. I think food prices, because of the sustained rain, has helped minimize the pain of the pandemic. So a big issue going into 2021, obviously, is going to be what happens to the rain. And if you look at the economic survey, agriculture is now 35% of our GDP. So the weighting of agriculture has progressively increased over the last, say, 5 to 10 years. So it's going to be tough for businesses, much as we look at the improvement, because even with things opening up, it's going to be gradual. Trade is not fully open because there are still restrictions on trading. Tourism numbers have still not come back in the same way they used to be. Conferencing, everyone is doing virtual conferences. So some of the things that were really stimulating the economy will take time to fully recover. Thank you.
Thanks, Jeff, for those sentiments. Now bringing in Jared to this conversation. We've had talks about the COVID-19 response by the government. We have the economic stimulus package, 56.7 billion. And just to pick your brain on this, what's your assessment on that? In my personal view, there are some of those policies that were put in place, say things to do with pending bills, that was 5 billion, payment of VAT refunds, another 5 billion, being claimed to be economic stimulus package didn't bode well with me. But perhaps just to get your view about this economic stimulus package, is it something that is worthwhile to look into, or what's your view on that?
Thank you, Churchill. I think to me, for any fiscal move to be characterized as a stimulus, it has to really be very ambitious. And right now, I see no scope for the fiscal policy to be very aggressive because of the debt situation that we find ourselves in. So things to do with pay pending bills, of course, will help because, I mean, that will stimulate a bit of demand. But how that plays out in totality is going to be a function of the balance between the obligation that the government has, how much revenue it has to collect, and then how that revenue is going to be deployed, balance between investments and recurrent expenditure. So that is the circumstance under which you can characterize whichever fiscal move that the government makes as a stimulus. We know that, if there's any bond that is issued, whether you call it a COVID bond or whichever brand you give it, essentially that will build into the extent to which the government is resorting to borrowing so that it can be able to meet its obligations. And that therefore speaks to the challenge that I alluded to in terms of really making the fiscal policy truly countercyclical. And that can only happen if we have fiscal space. You can imagine a situation where you are caught between a stone and a hard place. On the one hand, you want to use the fiscal platform as a way of injecting a bit of momentum for the economy. On the other hand, you have to do that in a manner that is very cautious to avoid building yourself into a much worse debt situation. You can imagine right now the conversation is going around trying to increase the debt ceiling and how it has been received. Obviously, many people are very negative about increasing the debt ceiling, whereas some could argue that unless the government borrows, and especially borrowing domestically, and that borrowing is deployed towards supporting the economic growth, then that's how you can start looking at it as a stimulus. Unfortunately, when you increase your debt borrowing, your domestic borrowing, you play into the aspect of crowding out effect. And we have substantial evidence that whenever the government is substantially in the market, you have crowding out effect, and that plays to that number that you alluded to, around 8% of private sector credit growth, which could be seen from two perspectives. On the one hand, there's a crowding out effect, meaning the government taking money that could otherwise be going to the private sector. On the other hand, is really the caution and risk averseness of the financial system, in view of the fact that the quality of the asset, as reflected in the non-performing loans, is really in the double-digit level. Therefore, that conundrum of wanting to have a stimulus and yet it cannot be a stimulus at the same time. So that's really how I see the interplay happening between those three aspects.
Thanks for that. Just to piggyback on what you said, you've mentioned the asset quality in the financial markets, and that in this kind of environment, it's spreading across different sectors of the economy. And what we are looking at, we are in the middle. The COVID-19 is still not yet out of the woods. And we are seeing some tax measures being put in place, corporate income tax back to 30%. We also have the minimum tax. We also have some other new taxation measures for the individuals. Do you think that the government got it right in terms of the bringing these tax measures and against the business cycle that you are in right now? Do you think that it was premature, or it was still in order to be able to meet the revenue targets that is being that the government is intending to meet?
I think it's a swing from being counterintuitive to the dilemma that the government is facing. If indeed you want to stimulate the economy by allowing some tax breaks, the reverse of the same could mean that you have a sense of confidence that the economy is on the right track. And I think it's really it's early days for you to say that now things have turned around and therefore you can make that reversal. But you can see where the government is coming from. I mean, meeting revenue targets is becoming very difficult. The only implausible assumption I see there is that taking the tax rates back will necessarily mean that you're going to collect more revenue, because there's usually no direct relationship between your increase in the tax rate and necessarily collecting more tax revenue. So that is really where I see a sense of a dilemma, and therefore the reversal of what would be characterized as a stimulus being almost counterintuitive in terms of how it was reversed, and it coming at a time where we haven't seen even the signs of the economy turning the corner.
Thanks, Jared. Jeff, just to bring you into this conversation, do you agree with Jared's sentiments?
Yes, indeed. I think if you look at it, the government is in a very tight spot given the current fiscal situation. In as much as we call it a stimulus, if you look at 56 billion is just slightly over $500 million. As a percentage of GDP, it's 0.5% of the overall GDP. So the question is it enough to create a positive effect in terms of trying to drive the economy forward? The reprieve at the moment seems to be a lot more around trying to delay some of this debt rescheduling could be the silver lining, because if you then make those savings and then reinvest that into the core economy, then that could provide a much larger, can I call it stimulus, than just looking at the 56 billion. But it's a tough spot of border because there are not too many choices, and so let's hope that we can have a bit more restructuring so that there's less short-term pain on the fiscal position.
Thanks, Jeff. There's a question on the Q&A segment to Jared. Let me just read it in verbatim. Mr. Osoro has mentioned that we are moving back to normalcy as opposed to the hyped new normal. Considering the changes globally and locally, I'll be glad if he clarifies this a bit. And two, is going back to normalcy as was before the way to go? This is from Laban. Jared, if you may take it.
Yeah. Let me. Thanks, Laban, for that observation. What I said is that a move to normalcy will be at best gradual. We're not going to have a quick turn to what you can call normalcy. And the reason why I say so is because I think what the pandemic has done is that it has morphed from being a short-term thing that people would assume will be addressed if we have a vaccine, to one that actually has led into some structural changes. You can imagine now the attitude of many countries insofar as what they're able to produce is concerned. People started looking at what they can produce for their own domestic market, because, you know, when you reach a situation where a pandemic comes and then borders are closed, and then if you are not self-sufficient so far production is concerned, then you probably have to see a challenge. So we're not going to see a return to normalcy, at least in the short term. Medium term, yes, we'll see a gradual return at best. So that's really the point that I was trying to make when I say that no, we'll see a gradual return to normalcy. But I think the other thing that you have to take into account is the fact that, you know, whereas, you know, the pandemic has exposed our fragilities, especially as small open economies, I think we still have to have it in mind that we will continue playing in the global space, because it's through the external markets that we are going to be able to meet the obligations of our external borrowings. It's through the external markets that we're going to see a situation where we address the imbalances between our domestic savings and our investment requirements because of the savings inflows that come either in form of borrowings or in terms of equity. So see in that context that, you know, yes, we'll still remain playing within the global space, but the circumstances under which we will operate will be different. That's the context around which I said a gradual return to what you can call a normal.
Thanks, Jared, for clarifying to Laban. Jeff, let me ask you this question. We are at a point whereby today is the 19th day in January. We haven't seen the third quarter GDP numbers, so obviously there's a delay in that. And then there's some data, not only with KNBS, but in some other sectors, whereby there's a delay in data. Do you think that from a policymaker's perspective that sometimes they are flying blind in terms of because of the dearth in data or a delay in data? Do you think that that is a concern that the policymakers need to address going forward?
Thanks, Churchill. I think it certainly is a big concern. And it's not just the delays, but also it's to ensure that the different arms of government and the different offices do release consistent data and at prescribed intervals. Otherwise, we've seen a lot of investors, especially on the debt side, find the information at times it's not consistent, and that makes it very difficult to understand to support the country by investing in the debt securities, then they can't because of just that lack of data. And then a lot of investors also start giving feedback that our financial system is a bit opaque, that we cannot really understand what's happening. There've been obviously some moves to try and remedy that, but these delays don't help at all. Thank you.
Thanks, Jeff, for that, short and precise. Still, this issue about disclosures, I know that one of the things that is attendant with Kenyans participating in the DSSI is that these should be increased disclosures on public debt issues. So Jared, do you think that we'll see some progress in these regards in light of the fact that the last public debt register is at June 2018. So we are 2.5 years behind in terms of disclosure of the public debt register.
Yeah, thanks, Churchill. I see that at two levels. The timeliness of disclosure as one aspect, and what you disclose as the other aspect. Essentially, what I mean here is that it's important for us to be really as current as possible as far as our disclosure is concerned, as a necessary condition. But the sufficient condition is really being accurate as far as what you disclose is concerned, because if you disclose and you've not disclosed contingent liabilities, I think then you're understating the extent to which debt could be a challenge to you. I think now the conversation around to what extent you disclose liabilities that are incurred by state-owned enterprises, where government has given some form of comfort to the borrowers, is very critical. And the other that really people are not talking about is really the liabilities associated with pensions. And that's really critical because if we are going to move, especially from what you can call the defined benefits scheme to a defined contribution scheme, at least we have to acknowledge that no, there's an issue there insofar as the disclosure of what government really owes is concerned. So to me, that's an issue. And I think the more you disclose that, the more you have an accurate position. And it's through that accurate position that then you start looking at what remedial measures you need to put in place for us to bring our debt levels into a sustainable sense. The conversation I typically hear is one where people are really fixated on the quantum of debt. You see numbers around how much debt do we have outstanding as a proportion of GDP, and the usual metrics of how that does relate to revenue, how does that relate to exports. I think the conversation should be a bit more deeper than that. We have to start looking at the structure of the debt. Is the tenor shrinking? Is the split between foreign and domestic really endearing itself to the extent to which the economy is playing out vis-a-vis the external economy? Such is the conversation that can give much more clarity. And if I can give just a quick observation around the debt issue, of course, not the debt, but data that you alluded earlier. I think usually there are various streams of data. There's data that you can get real time, especially financial data. But data that's linked to economic performance has to be seen in the context of there's usually a lag. But I think a good analytical outlook will entail that you pick some of the leading indicators, and you see how those leading indicators can actually play into predicting how the data is likely to perform going forward. So I think that is how I'll look at the data and agree with the CEO that I think the more we try to be as current as possible as far as data is concerned, the more we make it easier for the investors. Of course, bearing in mind that if the investors don't have the day-to-day data, they can take advantage of the leading indicators which you can get from the market.
Thanks, Jared, for that.
Thank you, Church. Yeah.
Just want to hear your sentiments around the Kenya shilling. From our view, we are seeing some weakening bias in the short term. I don't know, what's your view around the Kenya shilling?
Okay, my quick thoughts around the shilling is that I can actually, and this is not semantics, there's been a very big debate around the shilling. So you can talk about weakening, I can talk about correction. People have a fixation on the nominal exchange rate, meaning what the exchange rate is vis-a-vis the US dollar, for instance. To me, I look at it slightly deeper than that by just bringing in the fact that we have to look at how that relates to the real effective exchange rate, meaning how that attunes itself to the actual competitiveness of the economy. And when you see the nominal exchange rate not moving and the real exchange rate is moving, then at some point a correction must happen. And I think given that we have a liberalized foreign exchange regime, all that needs to happen is that the correction has to be gradual to avoid a sense of volatility. So what we are seeing in my mind is a correction, is not necessarily a manifestation of volatility. And that will entail a situation where if that correction happens in the correct manner, then we are likely to see that playing out into our external position or external balances insofar as the close of the current account is concerned. So that's how I see the shilling going forward. Obviously, you could expect that to have its own ramification, especially insofar as inflation is concerned. If we have a strong exchange rate pass-through to inflation, and also it will have ramifications so far as our external debt is concerned, because the more the currency moves, the more your external obligations are increasing relative, in terms of the local currency amounts. So those are some of the things that you have to bear in mind. But the bottom line is that I think see it as a correction. And that's really how I see the shilling.
Thanks. Correction. Thanks. Correction. Going for correction.
Yeah.
So at this point, let me now bring on board even our participants. I'll ask a poll to be put out so that we can just get the views of the other participants on this call. There's a poll that will be running shortly, just a few seconds. Our team is putting it up. Yeah, so there are two polls. So the first one is what's the expectation of 2021 growth? There are choices there, and then yeah, they are coming in slowly, nicely. I'll give it like 30 seconds, and then you can run the second poll. There are two polls, and then the other one is about public debt sustainability in the next 12 months. Can run it for say another 30 seconds. Oh yeah, it's running. There's a timer. Thanks. So I think we have managed to get the poll. So we can share the results. Yeah, so those are the results of our two polls that we did. So the first one was what is expectation of 2021 growth? Huge segment is now where Jared was talking about something below 5%. So between 2.5% to 5%, 56% of the poll respondents are agreeing with Jared's sentiments. And the other second poll is now the public debt sustainability in the next 12 months. I'm seeing 10% are saying that public debt will be sustainable, but whopping 90% are not agreeing with debt sustainability in the next 12 months. So Jeff, bringing you to this conversation, public debt, is it sustainable? Are you agreeing with the 90% or in the 10% lot?
Thanks, Churchill. I think I probably lean more to the 90% crew. And I think the first is just for us to have a very accurate assessment of what is the true debt that, that the country has. That has to be the first step, and then understand what is the term structure of that debt. I do know government has had a deliberate effort to try and lengthen the maturities of our debt, so that there's not too much pressure. But if you look at even just the bonds that are listed on the NSE, there are quite a lot of maturities coming up in the next 2 years, and so that will put a lot of pressure on the fiscal position. Thirdly, revenue collection will certainly be a challenge, because some of the key sectors which have anchored the economy, especially trade and tourism, conferencing, may take time before they come back on board fully, and that will be a big concern in terms of the revenue that's generated through those sorts of activities. So you can see lower revenue from government, already a higher debt exposure, and you still need to fund a lot of activities. We saw the letter from the Treasury CS to the governors talking about the fact that the entire streets right now, in terms of even making funding available to the counties to meet their obligations. So it's gonna be tough from a fiscal position. Thank you.
Thanks, Jeff, for those sentiments. And actually, I'm being corrected that the actual results for people who are not seeing debt being sustainable is 58%, it's not 90%. I think I saw my own things. So Jared, when you talk about public debt sustainability, of course, it comes from the budget, from the revenue and expenditure side. In your view, I think the focus right now has been on revenue, be it the tax changes that came at the front end of this year, and also from IMF talking about a fiscal consolidation, which is biased towards revenue. Do you think that it's a revenue issue or it's an expenditure issue?
I think it's a combination of both. You cannot, if you step back, you realize that for quite some time, our economy was being driven substantially by public expenditure, especially towards infrastructure. So if you have a revenue-leaning fiscal policy, then I think you're going to rob off the economy the opportunity to get the support of government so far as growth is concerned, because that growth is very important. So even you are talking about fiscal consolidation or a sustainable fiscal position, you have to look at it from both ends. And I think that also speaks to the extent to which the whole conversation around debt sustainability is playing out. Because now we are talking about getting budgetary support. For a very long time, we never used to get budgetary support from the World Bank, except during the structural adjustment period. So when you're getting budgetary support, that speaks to some of the challenges you have. When you're looking at things like the Paris Club and the non-Paris Club coming to your support, that simply speaks to the vulnerabilities that are there on the fiscal side of things. My analogy here is that you cannot say that you're okay if every day you're sleeping with painkillers by your bedside. So when you start seeing, you're really looking for some accommodation in form of a standby facility, budgetary support, and then debt suspension initiative. That then therefore tells that if you have to look at the fiscal position, then you have to look at it in a balanced manner. And I think the other thing is really you have to look at the interplay between the fiscal policy and monetary policy. And that's something that I think we are basically not giving a lot of attention to, because these two policies are really meant to work in tandem. If you have an accommodative monetary policy, then you cannot afford to start tweaking around in a policy and on the fiscal side in a manner that is not really linked to what's happening on the monetary policy side. And I think on the monetary policy side, just one thing to mention is that you have to look at, and you spend quite a bit of time in your presentation to talk about the CBR, which signals the monetary policy stance. If you really want to support that, what I described as a gradual correction of the currency, or you have to maintain stability of the currency by occasional, coming into the market to intervene, That intervention need not necessarily be a quantity intervention where you're coming to sell foreign exchange, as it were. You can actually do that by using monetary policy instruments such as the CPR itself, which brings another dilemma in the sense that no, you cannot have a very accommodative monetary policy and at the same time have a currency that is either appreciating or stable. You must trade one for the other. So those are the kind of juggling that you have to do between the fiscal side and the monetary policy side, and how the monetary policy can be deployed towards supporting the exchange rate. So that's really my take on that.
It seems that even the tone of the monetary policy communiques, the last 2 or 3, there's been a bias towards even that tone of the language. In my assessment, that they're looking at the fiscal policy side, be it stimulus package being acknowledged by the monetary policy. So do you think that right now fiscal policy is the one which is to do the most of the heavy lifting, or as you correctly put it, this should be a combination between monetary policy and also the fiscal policy?
Yeah, I think so. I think we have to expect the fiscal policy to do the heavy lifting, because there are limits beyond which you can deploy monetary policy. And in any event, monetary policy tools are attuned more to the demand side of the equation than the supply side of the equation. So if monetary policy is accommodative, and rightly so, as it is right now, then you should expect the fiscal policy to do the rest insofar as supporting the supply side of things. So I think there has to be an acknowledgement of the limitations of monetary policy, and therefore push towards seeing the fiscal policy do its bit amid the limitations that I've already alluded to on the fiscal policy side.
Thanks, Jared. So now we're coming to an end of this panel discussion. So I'll get your closing remarks. I'll start with Jeff. You can give your closing remarks.
Thank you very much for the panel. I think Jared has shared some very important insights for our clients to rely on as they continue this investment journey. If you look at it on the last topic area, while a lot of government discussion is around stimulus and the like, I don't think government has come up with a clear policy or approach towards expense reduction. I think if you look at every corporate, even the most profitable companies in this country, they have their eyes are really focused on the costs of running their operations, and especially having gone through a pandemic, we've seen a lot of companies look at that. So I think government also has to relook that aspect of, it's not just the revenue side, but you also have to look at the expenses. And I think there are some success stories. I'm just looking at the work being done by Kenya Railways now in terms of opening up some of the old railway lines. It's not too expensive, but it's beginning to make a very positive impact in terms of opening up some of the areas which were closed, and that should stimulate both travel and stimulate trade. So there's no one single silver bullet solution to this problem. So we just have to be a bit more ingenious. We have to stretch the shilling so that over time you can be able to get to a situation where the debt level is more sustainable. But I think the days of very big expenditures towards large infrastructure are not with us anymore. If you look at the example of what the Kenya Railways is going through in terms of reopening those transportation links. But otherwise, it's been a very useful session on this macroeconomic policy, and good to see the views of the public that people are skeptical whether we'll achieve the 5% GDP growth. And yeah, let's see what happens, and pray for rain, because I think if we have good rain, then we'll probably make it. If there's a drought as has been predicted, then it will be a tough year. Thank you.
Thanks, Jeff. Jared, your closing remarks.
Yeah, I think my closing remarks will pick from where Jeff concluded that we pray for rain. There was a very cheeky article by The Economist a few years back that a typical African economy performs well on account of either bad statistics or good weather. So if it's going to rain, we may do well. But I think for me, it's a case of people being optimistic, but in a manner that's realistically so. I think we are going to have a slightly better year than last year. But that doesn't mean that things are really going to be rosy. What we have in mind is a situation where, everybody is playing a very cautious game. Nobody is playing an aggressive game. So when we play defense, you expect the recovery to be at best very slow. But I think going forward, we are likely to see a situation where, as time goes and as people adjust, then we'll start seeing investors gaining more confidence and people willing to take more risks. Because right now, when you play a very defensive game, I think risk taking is going to be to take a back burner. That therefore means that people have to carefully weigh the kind of opportunities that come their way, and then out of that pick what would be a way of returning to where things used to be, or in your nomenclature, what you're calling the now normal. I think what we expect of policy is really to stabilize things as we transition. But most critically, as we go forward, I think we have to start putting a lot of effort in terms of to what extent we enhance our competitiveness as an economy. We right now, the conversation about competitiveness has almost been put on a back burner. And unless we address competitive issues, it simply means that we are not going to gain our position insofar as even the regional markets are concerned. Remember that we had started losing ground even before the pandemic insofar as our intra-regional trade is concerned. And it's simply because of our competitiveness challenges. And even Eva, she have said that we are going to see less interventions in infrastructure, heavy infrastructure investment. At least we expect resources to be deployed towards enhancing our competitiveness as an economy, so that we can have a scope to play in the regional and the continental league, as it were. So really, that's what I can see as my parting shots.
Thanks, Jared, for your parting shots. That marks the end of our first panel session. Thanks also, Jared, for honoring our invitation. And thanks, Jeff, for making it such a short notice to be part of this panel discussion. So back to you, Mainachage.
All right, thanks so much, Churchill Ogutu, and for that insightful panel discussion. And also to appreciate the panelists, Jared Osoro, and of course, the CEO, Genghis Capital, Geoffrey Gangler. Now, many thanks as well to all the viewers who are watching us on YouTube, and as well as panelists, some of them who are on the webinar. We appreciate all your questions. They have come in big numbers. And as I mentioned earlier, there will be a comprehensive document shared along with the Playbook 21 that we have, the 2021 Playbook that we're going to send to all participants. So all your questions will be answered. So keep them coming as well. If they were not answered in the panel, they will still come along. Now, at this moment, I want to move on to our next presentation, which we are going to have on the NSC 2021 focus. And this is being done by the chairman, Kiprono Kitoni, who is the chairman for the board on the Nairobi Securities Exchange. He's also the chairman of the Radio Africa Group and CEO of Real Time Capital. He's widely credited for the revival of the Kenya National Chamber of Commerce and Industry, where he was the former chair. So Kiprono Kitoni, welcome.
Thank you very much. Thank you very much. Let me start by recognizing the keynote speaker this morning, Mr. Baraku from the National Treasury, the chairman, Genghis Capital, my senior, Mr. Wangongu, the CEO, Mr. Gangler, CEO, Nairobi Securities Exchange, Jeff Odundo, PS Hinga, and other panelists. Before I make my presentation, let me just say I was really excited to hear Jared Osoro talk about our national competitiveness. I have, in my previous role as the chairman of the Chamber of Commerce, talked a lot about our national competitiveness, and it's something which, if we don't deal with as a country, then I suspect that we are going to be in quite big trouble in the years to come, because we are losing competitiveness in very, very many fronts. I want to also, by way of introduction, say it's a wonderful honor and privilege to take part in this virtual conference, and to really laud the management and the board of Genghis Capital for putting this together. It's really informative, very enjoyable, and certainly a good way to kickstart the year. And normally the month of January is a very good month to set to set priorities, to set benchmarks and to really focus on what needs to be done in the year ahead. I'm sitting overlooking I'm a Tamarind and I'm overlooking the Indian Ocean. So I'm in a lovely setting and I love being in Kenya. And I would also want to say that I have a comprehensive presentation ahead of us, just talking about what the NSE does. And I'll try and run through it as fast as possible, given the cognizant of the fact that time is in short supply. So I'll go slide by slide and I'll go straight to slide 1. And in slide 1, it just gives an overview of the NSE, who were founded in 1954 as a financial market infrastructure group. It is a leading financial market infrastructure group in the region. And on the second vertical, you will see the products that we have. You can go back here, that's equities, bonds, real estate investment trusts, ETFs, and derivatives. We are affiliated globally as well as regionally. And we are a fully demutualized exchange with a diversified shareholding base comprising of foreign institutional investors, as well as local investors amongst especially the brokerage community. So on the next slide, we'll go to the next slide, which is slide 3, which is about the NSE. And we offer a world-class platform for the issuance and trading in debt securities. Our mission is to connect capital to opportunities, enabling investors to build portfolios across a range of globally recognized investments, products, and issuers, raise initial and ongoing capital. So through the NSE, investors get access to access and exposure to Africa's fastest growing economies, and not just Kenya, but the region at large. Our market offers both quasi and advanced products, including real estate investment trusts, ETFs, and derivatives. And number 4, the 4th slide, deals with the priorities. And this is an interesting slide because last year when I took over the chairmanship, we really went down and we looked at the strategic plan that we had as the NSE, and we have developed certain priorities. And I'd like at this juncture to appreciate very much the role of the National Treasury, because one of our key priorities is to deal with the supply side. We are focused right now on increasing listings, and we are actually specifically at the moment targeting state-owned enterprises. And we have had very advanced engagement with the National Treasury, with several ministries of government, working to revive a structured privatization program through the Nairobi Securities Exchange. The program will target large cap state-owned enterprises in key sectors of the economy, in energy, in infrastructure, and we believe that this will revive interest in our market as well as encourage listing of private companies. You see, one of the interesting things about the NSE and even the COVID times, it has proven to be very resilient. I mean, and I'll share with you some of the statistics a bit later. We have made a proposal to government to support the sell down in terms of additional shareholding in some of the companies that are already listed. As you know, the government of Kenya still owns significant ownership and control in many enterprises. Some of these enterprises where the government has substantial shareholding include Safaricom, KCB, Kenya Re, and a few others that we still have room for additional reissuance of shares. And we believe that through this program, we can raise for government anything between 160 to 300 billion shillings. And I think at a time like this, when we are dealing with a challenge in terms of our national debt, I think that will go a long way in alleviating some of the pressure that the government is facing. We're also equally undertaking initiatives to enhance market liquidity, and we're working towards actualizing day trading, which means that we're shortening the trading cycle. So you can actually initiate a trade on the same day and realize its value on the same day, as well as securities, lending and borrowing. So we are creating a far more dynamic market, a far more fluid market that will allow movement of stock from one hand to another. And talking about shareholding and listings, we are also, as part of our strategy, looking at increasing retail participation. We'd like to see more local investors taking part, especially through collective investment groups, SACCOs, cooperatives, and others. We are also really focused on governance, and we believe that there is actually empirical evidence that good corporate governance leads to the resilient wealth creation. So those are just some of the key priorities that we have in the immediate future of the NSE. Slide 5, which is the next slide, is an overview of Kenya's economic performance in 2020. And again, on this one, I shall not go into great detail because a lot of information has already been shared by the National Treasury and by some of the other previous presenters. But suffice it to say that COVID-19 has had a profound impact on our economy as it has on the global economy. And the outbreak of the virus resulted in a sharp contraction of our GDP. And this was a result of disruption of supply chains and movement restrictions that affected remittances from key economic sectors such as agriculture, transport, and tourism. I'm sitting in Mombasa right now, and I can tell you the place is fairly empty. The country also saw a volatile currency environment, and according to the World Bank analysis, the contraction of our economy is anything up to 1.5% in 2020, and perhaps even 2%. And the government has, however, enacted critical fiscal and monetary policies to support the healthcare system and protect the most vulnerable households. We are one of the first economies in the continent that will be getting into a vaccination program and supporting also farms that are in order to preserve jobs. I think there's been a lot of initiatives, both by government and even by other donors like MasterCard to support the small and medium-sized enterprise ecosystem. And this, in a way, this has a direct impact in terms of protecting incomes, protecting livelihoods, and also our economy's productive potential. We've also seen key measures by the central bank, such as the reduction of central bank rates. Equally, the cash reserve ratio was reduced in 2020 to increase liquidity in the market. The downturn in economic growth reflects the more severe economic impact of the pandemic, and the economic impact of the pandemic to date is higher than had actually been initially anticipated. I think we'll all agree that in about March, April last year, when the pandemic was announced, we thought this was going to be a 2, 3, 4 month affair. But it's a year now, and we are still battling with the effects of COVID. And we've seen it also lead to a fiscal deficit widening to 8.2% of GDP, up from the pre-COVID budget target of 6% of GDP. So the fiscal deficit is a worrying factor. And I think we have talked about the lending and the crowding out effect, which Mr. Osoro talked about a little bit earlier on. And going forward, the country's economic outlook remains highly uncertain, as does the global economy. And COVID pandemic continues to present a huge challenge, both from a healthcare point of view, as well as from a livelihoods point of view, as well as the point of view of the economy. And however, we do remain hopeful that 2021 will see a rebound in terms of growth, and all indicators are actually leading us to believe that we may have up to a 6.9% GDP growth in this current year. I'll go now to the region, which is slide 6, and I'll talk about the region. And again, I am so happy that we had a small conversation earlier about competitiveness. And driven by the economic fallout of COVID-19, growth in sub-Saharan Africa is predicted to fall to minus 3.3% in 2020, pushing the region into the first recession in 25 years. We haven't had a recession here for 25 years. And the pandemic could also drive up to 40 million people into extreme poverty in Africa, erasing the last 5 years of progress in fighting poverty. The decline in growth has also been stronger among commodity and oil-based economies as travel restrictions pose challenges in key export markets. And in that regard, I think we are quite glad that Kenya is a fairly diversified economy, not reliant on any specific resources. So in non-resource intensive countries, the decline in growth is expected to be moderate to average. And you can see in our own case, we are predicting that we have potential GDP growth of between 5 to 6% this year. So the substantial downturn in economic activity in this region will cost the region at least $115 billion in output losses this year. GDP per capita growth is expected to contract by nearly 6%, in part because of lower domestic consumption and investment brought by containment measures to slow the spread of coronavirus. And the region is expected to make a slow recovery in 2021, underpinned by availability and rollout of vaccines. So in a way, actually, because of the fact that we have a diversified economy in Kenya, it gives us a very good opportunity to address our competitiveness, to address the role that we shall play in the region. And in that regard, I want to also assure you that the NSE is doing everything it can to position itself not as just as a leading exchange in Kenya, but a leading exchange in the region, East and Central African region, second only to perhaps Lagos, Nigeria, Johannesburg, and Cairo. I'll move on quickly to the 7th slide, which is on the global economic outlook. And of course, this dampened in 2020 for the reasons that I've mentioned earlier. And pending revision, in 2021, the global economic outlook was revised downwards by the IMF in October 2020 from minus 4.9% in June to minus 4.4%, which effectively means that we are going to have a shrinking of the global economy, however way we look at it. A slow recovery is expected in countries such as China, which is expected to record growth this year. So the picture is more or less the same. I mean, COVID continues to contract economies globally, and we are no exception. I wouldn't want to go into each of the regions specifically, because I do believe that this slide will be shared with all the participants today. So the next slide goes into market performance and the impact that COVID-19 has had on the region, and especially in our markets. And performance of listed securities in 2020 remained subdued in congruence with global asset prices, which were characterized by a sharp price volatility. And uncertainty caused by the outbreak and spread of COVID-19 weighed negatively on investor sentiments. And as you know, markets are driven by sentiments. And this has led to capital outflow as investors adopted safer investment strategies as they assessed the impact of the virus on investments. The NSE is considered a frontier exchange. There are, in terms of category, there's frontier, then there's emerging, and then there are mature market bourses. So we are deemed as a frontier bourse, and hence the risk attendant to investing here is higher. However, it's not a surprise we expected investors to practice cautious investing as the pandemic has played out. The most impacted asset classes were equities, which saw a significant capital flight as opposed to bonds. The NSE benchmark indices saw significant drops, and you can see them in the graphs before you, reflecting the impact of the virus on listed securities. The main index that we use, the NSE share index, was down 29.6%, closing the year at just slightly under 1900. And the all-inclusive, the NSI shed 14.3 points to settle at 152.11, while the NSE 25 share index declined by 16% to settle at 3,415. Market capitalization, which measures the value of all listed equities, declined by 8% to settle at 2.3 trillion against 2.5 trillion posted the year before. We expect significant growth in the index this year, underpinned by prospective recovery amongst listed assets. So whereas there has been a bit of contraction in performance of the exchange, I want to emphasize the fact that we have proven that we are very resilient. If you go to some of the other frontier and emerging markets and looked at similar graphs, they'll show a much greater decline. So the flat curves that you can see in front of you are not necessarily disastrous. In fact, they do prove the point that we are fairly resilient, and with a bit of work, especially on the supply side, we should be able to see significant growth in our market. So back to what I was talking to you earlier, if we can get the government, and I'm really appreciative of the National Treasury's commitment to having a vibrant exchange and a vibrant capital market, if we can deal with the supply side, there isn't an issue with the demand side. There's very high appetite, despite the fact that 70% of the investment in our market is foreign investment. There's a very strong appetite and demand for equities and bonds in our market. The next slide, dealing with market performance. The impact of COVID-19 can be seen on how the market performed in 2020, whereas activity remained stable with high volatility experienced in the first half of 2020. In 2020, we posted a 3.34% decline in equity turnover year on year to 148.3 billion shillings, compared to 153.8 billion on the year before, that's 2019. The bond market has shown extremely positive performance, posting a marginal increase in turnover of 6% to about 691 billion compared to 651 billion in 2019. So bonds are performing very well. And we have some innovative new ideas about how we can get even state-owned enterprises to list bonds and even encourage more green bonds and other corporate bonds. The pandemic has also proven an opportunity to investors to manage downside risk through our diverse investment products. The ABSA New Gold ETF was a runaway asset, posting a strong performance with its turnover increasing by over 7,500% and its value increasing by over 34%. So the pandemic validated our strategy of providing investors with various instruments to deploy capital. And last year, but one, as a guest at the African Exchanges conference in Botswana, I was actually glad because I just joined the board to note that we were considered the most innovative exchange in the continent of Africa. But again, it's almost biblical because they say a prophet is not recognized in one's own territory. So the work that is being done by the team at the exchange is actually quite laudable, particularly if you look at it from a Pan-African perspective. So the next slide, that's slide 11, which is Kenya's weighting in MSCI index rising. One of the key recent developments is the increase in our weighting in the Morgan Stanley Capital Index, which is a key global index. One of our key objectives in our current strategic period is to enhance our status from a frontier market into an emerging market. That'll enable us to access a lot more capital than we do right now. And we are among the top 4 most important frontier markets globally right now. But we're not satisfied with being a frontier market. We'd like to up our game and move ourselves into becoming an emerging market. The increase in Kenya's weighting in Morgan Stanley's index, which became effective in November 2020, will potentially boost foreign portfolio investment inflows. So the increase in weighting, as well as the reclassification of Kuwait, will turn investor focus to listed companies in the NSE. Hence, it being very important that we also deal with the supply side by having significant additional drawdown of listings, as well as some IPOs. We would like to even persuade government to look at companies like Kenya Pipeline and many others that we think are ripe for listing. In slide 12, I'll just go very briefly into the impact of COVID on regional and global markets. And most global markets, recorded returns of in excess of 20% or 40%. The UK remained one of the most adversely affected markets, recording a 13% decline in 2020. And global markets are expected to maintain a positive performance in 2021, following a vaccine rollout in many parts of the developed world. And African markets had a tough year. I mean, the worst hit was Uganda, which had a shrinkage of 27% value, and Rwanda was the best performer, albeit operating from a fairly small base with a gain of about 4%. So that really brings me to the end of my presentation. But suffice it to say that we are, really burning the midnight oil to try to create a vibrant exchange to become a point of reference in terms of financial intermediation in our continent and in our country. We'd also want, to use the opportunity to try to encourage Kenyans to diversify their own investment portfolio. I think we have seen a correction taking place in real estate prices. Most Kenyans have a very, very strong appetite for investment in real estate, in land. And we want to use this moment, especially when there's correction taking place in that regard, to get people as much as possible to take an interest in investing in equities and in bonds. So I conclude by really appreciating Genghis Capital for putting together this very interactive, very informative session that really should be an annual event for which the NSC is committed to participate in, not just this year, but in the years to come. Thank you very much.
Thank you so much, Kiprono Kituni, Chairman, the Nairobi Securities Exchange, for those remarks. Indeed, we are fairly resilient, as you have said, as a market. And we look forward to an amazing 2021 with all the strategies that you've spoken about. And of course, just to applaud the efforts that we have seen as well, that you have been doing to endear the market, even to retailers across this country. And of course, just to recognize that Genghis Capital as well has not been left behind with a lot of the weekly webinars, which I am a staunch follower of the conversations that go on that indeed enable retailers to understand the market and to flow in. So we look forward to an amazing 2021 where there will be a lot of participation. Next in the program is another amazing panel discussion that will be led by one of our researchers, Gerald Murioki. And I want to just quickly mention the panelists that we have. First, we have Dr. Samuel Tiriongo. He's the Director, Research and Policy at KBA. Samuel is an economist with 13 years experience in central banking, 11 of which is attached to the Secretariat of the Monetary Policy Committee of the Central Bank. Then we have the CEO, Nairobi Securities Exchange, Geoffrey Odundo, who is a seasoned investment banker for the last 23 years with specialization in insurance, risk management, asset management, corporate finance, and securities trading. And finally, we have Job Wanjohi, Head of Policy Research and Advocacy, Kenya Association of Manufacturers. Job is a seasoned economist with Kenya Association of Manufacturers as well. That's the panel we have, and Gerald Murioki is seated right here, ready to go. Gerald, over to you.
Thank you, MC. I think before we can begin with the panel, we'll make a short presentation on the equities side. Yes, so in my presentation, I'll begin by a recap of the equities market in 2020. Globally, we saw a lot of economic stimulus packages. I think these were estimated to the tune of about 20 trillion USD. And this is basically to respond to the unprecedented level of the pandemic and its effect on basically the global economy. So again, most of this stimulus flew into the equities market. I think when you look at the developed equities market, they were in the positive last year compared to the frontier and equities and local market, which were negative in last year. Again, local markets basically downtrend over the course of last year. I think we'll show this in a slide, in a subsequent slide about the performance of some of the comparables. Economies were basically affected by the tough business environment, closure of economies to stem the spread of the pandemic. And then locally in the equities market, we saw a relatively low equities turnover. I think this was down about 3.8%. And also coming down also from the previous year at about 12.4%. Foreign investor activity was down about 29 billion compared to inflows of about 3 billion in the prior year. I think there was a lot of cautiousness, not just in the local market, but also in frontier markets generally. However, we saw a lot of continuation of merger activity, especially in the banking sector and also on the manufacturing sector of the NSC. So these are basically charts of performance of the markets locally and also across the frontier markets. So you can see equities turnover steadily coming down quarter on a quarter basis to a low of about 26.7 billion in the fourth quarter. And then when you look at the net foreign flows, quite low levels in March period, but this subsequently subsided. And we actually saw some positive flows during July, the August and September period. So basically we are seeing foreign investors start looking at the markets, favorably. I think where the markets currently are, it's a good opportunity for entry for most investors who have a long-term outlook. So SSA, we can see most of the SSA markets, Kenya, Ghana, Botswana, Tanzania, and also Uganda were basically in the negative. but Nigeria was an outlier during last year, up about 36.7%. I think most of our investors were wondering what was happening in Nigeria, which didn't follow most of the other markets. And basically this was because of liquidity flows in the equities market. There was some policy action during the late part of 2019 by the government, which basically moved most of the investments and liquidity into the equities markets. So in terms of foreign participation, steadily coming down from 75, about 75% in the first quarter of 2019. And then this averaged about 61 to 66% over the quarters of last year. So our track record, quite solid, quite good. If you look at our momentum portfolio, was up about 13.4%. This is since inception in 2019 when we basically started tracking these portfolios. And this is an outperformance of about 47% against the NSE 20 index, basically the benchmark index, and also outperformed the Nairobi All Share Index at about 5 percentage points. So our portfolios, which we track on a weekly basis, and we inform our investors the performance on a weekly basis, continue being performing quite positively. Again, our income portfolio basically are the stocks that have a high dividend yield and also sustainably high dividend payout, was about within the range of the Nairobi All Share Index. So our only negative portfolio was the value portfolio, which was about 8.9% in the negative, but still quite an outperformance against the NSE 20 share index, which is quite an attractive performance compared to the benchmark NSE 20 index. So in terms of expectations for 2021, markets have come down over last year. I think they stated at around the third quarter or fourth quarter, they stated at some point, and we have a chart on your right that indicates where market had bottomed out in the period of third quarter, fourth quarter, beginning of fourth quarter, and you're seeing them now coming down. I think coming up. I think foreign investors, especially, are now positively looking at the market, the undervalued opportunities in the market, and you'll see that the market has risen, and it's mostly because of a few stocks, and especially one large stock, which has been trading at all-time highs recently, and most of the other stocks are still trading at very discounted levels. So when you look at the history on a historical basis, we are looking at market price earnings ratio about 10 times, the lowest it has ever been over the last 5 years. And this definitely talks about entry opportunities in the current market for most of the other stocks that are still undervalued. So again, we are looking at cautiously optimistic foreign flows, basically from the bargain stocks that had been oversold over the course of last year. Again, as much as we expect the stocks basically to rise to their valuations, we still see a lot of skewness towards the large stocks, the fundamentally strong stocks, and stocks that have a higher growth prospects, especially in this period that business sentiment is still quite low. Again, as the chair has highlighted, the additional weighting, about 3% in the MSCI frontier market indices, is basically going to be a positive event for our markets. And the MSCI indices are quite significant because when you look at the AUM, basically the assets under management that follow these indices, they estimated about $12 trillion. So it's quite a huge event when market gets an upgrade in the index. So again, there was also inclusion of a KCB group in the FM index, basically the frontier markets index. It was previously in the small cap index. So this is definitely going to be a positive for that stock. But however, we still see foreign investors, looking at the risks that are still, that are still apparent, especially the business recovery side. I think it's much slower, especially in certain sectors. Our sovereign debt levels, I think this is one of the areas that had been highlighted in the macro section of our presentation. And then the heightening political uncertainty and activities. Still, we are seeing a lot of political activity, and starting with the referendum this year and spreading into the general election into next year. So this is definitely going to affect how business make their long-term investment decisions. So in terms of key recommendations from the banking side, the long-term prospects for the banking sector are quite positive, despite the sell-off of last year. And I look at the sell-off in terms of an opportunity to come in to undervalued banks and to come into undervalued stocks generally at very attractive price levels. But however, given the market and uncertainties that are still there in the economy, I think the smartest way to look at investments in this environment is to have a long-term outlook, because in the short term, there's going to be a lot of volatility, but in the long term, there's still going to be some good returns for investors who will be able to ride out this environment. So for the banking sector, we expect some cautious growth in the loan book. I think this is now stretching for a couple of years since the interest rate cap into last year. So even the environment is still yet to improve. And there's also the concerns about the structured book, about 1.4 trillion. I think this is still something that is going to be a headache for the sector into this year. So we don't expect some aggressive loan book growth over the course of this year. Again, gradual improvement in the net interest margin. This is definitely from the government side. We expect some pressure, upward pressure on the yields, because again, government is very heavy on local borrowing. And also we are looking at a situation where the Central Bank of Kenya will start approving some of the risk-based customer models. Some of these were to be approved last year, but we expect this to start being approved as from this year, so that to support the private sector credit. So on your right, we'll see some expectations in terms of asset compositioning of some of the key banks that we are following. And basically you'll see that the government security side is expected to rise much faster compared to the loan book assets. Again, net interest margins across most of the key banks are expected to rise compared to their levels in 2019. So our key recommendations in the banking space, basically buys on KCB, Equity, and Absa Bank, and then holds on Coop Bank and Standard Chartered Bank, but the entire weight for the sector is basically a buy. I think for Coop Bank, last year they were a bit cautious in terms of provisioning levels, and I think they have to be much more aggressive in terms of provisioning compared to their peers, and to catch up also and match some of their peers. For KCB and Equity Group, we saw them as much as there was a pandemic and all sorts of problems, they were still quite aggressive in terms of regional growth, especially in the Rwanda market. This is a market that has been upcoming over the recent years, and it's showing some promise, and that's why we're seeing a lot of investments by both KCB Group and Equity Group. So again, for both key two banks, some strong operating metrics, net interest margin above 8%, digitization benefits. I think these are some of the banks that are highly digitized, reporting above 97% of their transactions occurring outside the branch. Again, Equity banks tends to impress us in terms of non-interest revenue channels, which is on average is much higher than the sector average of about 40%. So risks, however, are still there for the sector, which may limit short-term upside on the banking side. I think one of the key risks we are looking at is basically the elevated cost of risk this year. Yeah, last year for most of the banks, it was coming to about 4%. For the two key banks, about 3 to 4%, but we still expect this to remain high into this year. Again, we expect some weaker asset quality, basically due to restructured book, and any bank that will be aggressive in terms of lending in the current environment is expected to have some issues with the assets. So again, one of the key areas that for investors will be about the dividends this year. I think it will be continuation of what we saw for some banks or last year, and given that some of these matters are now under the regulator. For example, this dividend cut, payment of dividend will have to be approved by the regulator. And I think the regulator is more of a pro-capital rather than pro-dividend. I think I'm not looking at a scenario where the banks will be issuing the full dividends as they have been over the last normal years. So on the non-financial side, Safaricom, which has been trading at all-time highs recently, our recommendation is a hold at a valuation of about 32.72. However, we are looking at some very good growth in the business, basically from the M-Pesa side and the data side. M-Pesa has been impressing us over the recent years before the COVID measures were put in place by the Central Bank of Kenya. But this now is expected to start contributing back after they were lifted in January. Again, the new products have been resonating with the customers, and the uptick has been quite good. For example, for Lisa, and you're still seeing the business trying to innovate and coming up with innovative products, and they've talked about unit transport products and savings products which are in the pipeline. Again, data segment has been one of the key fastest growth areas for the business, and we have seen them aggressively investing in the fiber network. And I believe that this has not only propelled them to the top market, to the top share in the fiber business segment, but also in terms of revenue growth. Again, one of the other areas that investors have been keen on is the potential in Ethiopia. So Ethiopia is quite a big market, 100 million population market, but still 70%, about 70% of the populace is still not served by financial services. So still quite a good market and offers quite good opportunities. However, we are seeing over recent years, due to maturity of certain segments like voice and SMS, and these tend to be the highest contributors to revenue. These are expected to be slowing down the business in terms of growth in revenue. EABL and Kenyan both buys based on fair values of 194.32 and 7.11. 7.11 for EBL and Kenyan. I think both of the businesses have similar characteristics over the recent years. And this is basically investment in capacity increases. For EBL, we saw Kisumu brewery that came on board in the late part of 2019. However, due to disruptions of the pandemic, we couldn't see some volumes coming in from that side. But Kenyan on the other side, again, a lot of capacity expansion. 2019, they came up with Olkaria 5 power plant. I think in the next 1 year, we are looking at Olkaria 1 unit 6, another large power plant. And then in the next about another 2 years, there's going to be another Olkaria power plant. So both businesses basically increasing their capacity. And when you look at their multiples, for example, if you look at EABL, the forward EBITDA has come down to about 5.9 from an average of about 7.4 times. And this is below the peers average. And when you consider that historically EABL has been having a superior ROE compared to peers, then you're looking at a very attractive stock in the current market. However, the key risks, and I think this is going to be an issue going forward for some time, is the unexpected tax adjustments by government. I think this is one of the areas that government usually looks at every time they are looking at plugging budget deficits and increase in revenues. So For Kengen, the key risk is about the single buyer risk. As we have always been highlighting about Kengen, the price of Kengen and the price of KPLC tends to be highly correlated. So they tend to move together, and KPLC tends to lead the way. So when KPLC is going down, you'll find that Kengen will also be following. When it's going up, you'll find that Kengen is also following. So definitely due to the issues that have been there for KPLC, you'll find that Kengen has been suffering from that end, despite being a more solid business and having a more clear-cut growth path. So in terms of our equities model portfolio, as I had mentioned previously, we have 4 portfolios: momentum, income, and value. Momentum portfolio are basically the very high liquid stocks. They tend to be very sensitive to the market, and then they usually tend to show the most foreign interest. So this will find them to be EABL, Safaricom, KCB, and Equity Group. Now, on the income portfolio, basically it's companies that have a very stable dividend payout. They have a very high yield with a minimum of about 6%, and they also tend to have an upside potential. So for our income portfolio for this year, since we do not expect more cash dividends to be paid out, we are urging investors who are purely income investors to look at the fixed income side as a short-term strategies, because we do not expect cash dividend income from most of these stocks. So our value portfolio, again, they tend to be priced at a discount. They tend to be priced at a discount to their fundamental value, and here we are looking at the book value. Then they tend to have a significant capital potential, and they tend to be, again, considered bargain counters. Actually, our value portfolio this year is an outperformer compared to the market and also compared to the other portfolios. So this is our equities model portfolio for 2020. So we have our momentum stocks, equity, ABL, KCB, and Safaricom. We have basically maintained this portfolio to where they have been. Income stocks, basically KCB, ABSA, Corp, Stanchart, and Kengen. Kengen is here because of a div yield that has risen because of basically the price depreciation over last year. And then the value stocks are basically ABL, Kengen, and Kenyari. And this is, again, this on a weighted basis, this has the largest return potential, about 31.2%, followed by the income portfolio, about 21%, and then the momentum portfolio has an upside of about 17.7%. So that marks the end of my presentation. I think I'll hand back to the MC for the next session.
All right, thanks, Gerald. Sorry, I preempted you to the panel immediately after, maybe because I was looking forward to hear from these captains of industry to tell us more. But thanks for that overlook on how the equities in-house views by Genghis Capital will look like, and the Genghis model stock portfolio launch. So much appreciated for that. So right about now, the panelists that are introduced and gave their portfolios will be diving in now into the conversation, still moderated by Gerald. That's Geoffrey Odundo, the CEO of Nairobi Securities Exchange, Dr. Samuel Tiriongo, Director of Research and Policy at KBA, and Job Wanjohi, Head of Policy Research and Advocacy at the Kenya Association of Manufacturers. Over to you, Gerald, for that amazing discussion. So to our panelists, kindly join in.
Thank you, MC, and thank you, my panelists. I have the CEO of the Nairobi Securities Exchange, Mr. Geoffrey Odundo. And then joining me also is Dr. Samuel Tiriongo, who's the Director of Research and Policy at the Kenya Bankers of Association. And also I have Mr. Job Wanjohi, who is the head of research and policy at the Kenya Association of Manufacturers. So thank you, gentlemen, for joining me and joining us in this session. Maybe as a beginner into the session is to Mr. Jeffrey Odundo. In terms of market performance and market where it has traded at last year, what we have learned from the pandemic and what has changed, from the effects of the pandemic, and what are some of the key takeouts that we can basically derive from all the effects of the pandemic. To you, Mr. Jeffrey.
Thank you. Good morning, ladies and gentlemen, our chief guests, if they're still present, the audience, and chairman and the CEO of Genghis Capital. Thank you for really being there. My chairman, Mr. Giprono, for your very, very insightful perspective of the NSE and what are some of the things that we've done. Thank you very much. And to your point about what are the perspectives of how the market has operated in the last 1 year and how has this informed some of the decisions that we've taken. So as the chairman highlighted earlier, one of the key achievements for the NSE last year was the ability to take the market on a full remote cycle to enable it to trade efficiently on a very remote basis. So the impact of the pandemic definitely in the first quarter of last year affected the market greatly. We lost almost 25% valuation on the index, and the market cap was also affected largely. And that basically had a snowballing effect throughout the year because it led to an immediate decline in prices from where they were at the beginning of the year. What was really a great achievement for us was for us to be able to put in place our business continuity plans and take the entire market on a remote trading environment, right from the infrastructure itself and also the links with the trading community. In fact, to date, most of our players are still trading from the comfort of their houses without having any hitches or any issues regarding latency or ability for them to execute their trades properly. The other key learning point that came from this particular experience last year was the ability for investors to look at the market, especially from a domestic side. For a long time, we've been really trying to advocate for domestic investors to be very active in the market. But in 2020, they demonstrated this. And I think it was out of the ability for them to now have more time to spend and see how the market operates, the great valuations that the markets are providing, and some of the stocks that were not readily available were now a bit more liquid, given that the international investors were sort of retreating out of the market for the very short term. We also saw our alternative asset classes become very active. I'd like to point out here the great success of our gold ETF, the Absa Gold ETF, that performed exceptionally well, attaining a high price of about over 2,100. And that was a significant development and really a sign that at times like this, diversification is very important for the market. Now, one of the great things that happened to our market was that despite the challenges of COVID, we were still able to maintain a good trading environment, and hence our trading volumes last year only dipped 5% in terms of the sale from the equity side. And that was just a demonstration that investors have a lot of confidence in this market. They're very happy with the macros of the country. They're possibly very happy with the infrastructure and how it's been able to trade. And so we did not see a major decline in volume, unlike what has happened to other exchanges in the region, which have seen significant drop in volumes. On the other hand, our bond market performed extremely well. It's even performed higher than what it did in 2019. And that, again, was a good demonstration that the market has been very active and is actually a very established market now, and one of the leading markets for sovereign debt paper in Africa. So some of the key takeaways from this and from this experience is that into the future, we are now looking at how we're going to be able to maintain a very robust system that can withstand the shocks that we experienced. As you rightly pointed out earlier, we're not out of the woods with COVID, so we must remain very focused on keeping the market very, very safe for both the investors and also for our trading participants and anybody who interacts with us. It has called for the need for diversification, and that's why we're happy that we had put in place new products like derivatives, ETFs, and real estate investment trusts as alternatives for investors to look at and to diversify their portfolios. And that's another area that we feel is going to be a focus area going forward. I think we are continuously going to see investment in fixed income as a priority, especially as the global risks still remain alive and as they taper off. And so we're happy to say that at the NSC, our fixed income is very, very well established. We've got very good connectivity with the depositories, both the central bank and the CDSC, and hence the government and even private investors are now able to issue new issuances in the market and have this trading seamlessly. The market is very liquid and deep, and so we are seeing quite some good activity and would like to encourage that. We are potentially seeing the market becoming an issuers market. For a long time, we've not seen issuers coming to the market, but I think now we've presented a case for post-COVID recovery stimulus in terms of investors coming to look at the market and seeing how they can tap into capital market financing, which has not been their priority for a long time. And we believe that, as the chairman said earlier, starting with the government, want to really engage issuers to really look at the market as a funding channel. And we've got a good number of investors, both domestic and international, who are willing to place their money in the assets that are listed on the exchange. And so that's going to be our very key focus in terms of focusing on increasing market size and in terms of enhancing liquidity, including unlocking some of these shares that we have through securities lending and borrowing, and also introducing day trading as aspects and tools for us to enhance liquidity and hence make the markets increasingly attractive. The NSC is a leading player in sustainable financing. As you're aware, last year we issued a green bond. One of our players issued a green bond, and we're expecting to see more focus on raising of green finance assets coming to the market. And this is going to present an opportunity for investors in these areas to look at how they can tap into this, both the private and public and government sectors to really focus on this. So in a nutshell, our synopsis for 2021, as earlier speakers have spoken, is a very, very optimistic one. I think all the analysts have said that. The multiples are very attractive. The price to book ratios of all the stocks in the counter are very attractive. Our bond market yields are also very attractive. And so we can only put a case and say that I think this is going to be the right time to buy. I know we've got headwinds from the political conversations that have started, but I think the market has been very, very resilient to these headwinds, and we can see ourselves actually having a better year than we did last year. So I'll probably pause there and maybe allow my colleagues to also provide the insights. Thank you.
Thank you, Jeff, for those insights. To Dr. Samuel Tiriongo, what from the banking sector's perspective, what has been the key emerging issues from the pandemic, and how are these expected to shape banking going forward?
Thank you, Gerard. And again, I think I join the other speakers in really appreciating Genghis Capital for creating this forum where we can engage and really shape discussions in the market, and of course, also the way forward with regard to some of the issues that affect performances of markets. So before I probably talk about the focus for 2021 is really just to provide a kind of a background on the state of the banking sector, just to really situate the banking sector and for us even to discuss the way forward in a more structured way. So again, the story of resilience, as mentioned by the chair of NSE and again reinforced by Jeff, is that we've seen a resilient sector in terms of how it has actually weathered the pandemic, the effects of the pandemic. So we've seen a very stable and sound banking sector, of course, looking at the capital ratios and liquidity ratios way above the statutory minimums throughout the period before the pandemic and even during the pandemic period. And also at the same time, even before the first case of COVID-19 was announced in the country, we were actually, the banking sector was gearing up to really increase the credit flows to the private sector. And ideally, this was just following the complete repeal of the interest rate caps that happened in late 2019. So you could see that we're moving towards the 10% kind of growth in credit by March, April, thereabouts. And this was really on the back of a projected economic growth that was actually edging upwards, because we were coming from a 5.4 growth in 2019, now looking at over 6% growth for 2020. So there was every reason to look at the economy in terms of the pre-existing conditions were really ready for a strong takeoff of the economy. So even banks were lining up themselves to really increase growth. Then even when you consider the asset quality assessment at the time, from 2018 all the way to the beginning of 2020, there was no kind of an adverse movement on the asset quality side. If we look at the ratio of NPLs to the gross loans, it was more or less steady at around 12.5, 12.6%. And this was really kind of an indicator that we are not looking at worse conditions to come later. Then COVID came. Of course, many speakers have associated this with many disruptions that affected most of the economic sectors, and that included that included also the banking sector. And of course, there was a trigger to some mitigation measures that were actually deployed, both from the policy side and as well as even the banking sector side. So if you look at the policy side, of course, the adjustments in the central bank rate and the CRR by 125 basis points was a strong indication that really there was need to soften the impact of the pandemic and provide the economy with a much needed reprieve. And the additional measures that were also deployed included even that touched on some prudential guidelines, really. And this included the allowing some space for loan restructuring that would really support sectors hardly hit by the pandemic. And this was squarely on the desk of the banking institutions to really deploy these measures and allow customers. And of course, it was also in the interest of the banking sector that because of the hard pressing conditions and the unprecedented effects of the pandemic, there was need to reconsider a kind of a win-win situation in terms of allowing the loans to be repaid in a more feasible manner. So loans have been restructured, and really now we're looking at 1.4 trillion. So it's about close to half of the loan book has been recovered. This is restructured, and this is really as at the fourth quarter of 2020. And if we look at the sectors that have really benefited from this, are really those that were squarely affected by the pandemic, which was actually the intention of the loan restructuring program. You look at personal loan books, trade, real estate, and manufacturing sector. These are the key sectors that really have seen their loans restructured. And of course, this was really to provide the reprieve that was much needed. And during this period, again, we've seen the banking sector display extreme resilience because asset quality, in as much as it deteriorated a bit, we actually saw that the capital adequacy ratios and liquidity remained quite strong and well above. Like, for instance, the capital adequacy ratio was more than 3% above the statutory minimum. And even the liquidity ratio was more than 30% above the statutory minimum. And in as much as there was a slight deterioration in the asset quality, which is something that has been highlighted by previous speakers that actually touched on the performance of the equities, banking sector equities in the stock market. We had actually anticipated this going by the unprecedented effects that this COVID-19 had on economic activities, and by so saying, actually, the ability of borrowers to service their loans was kind of strained. So it was anticipated. But now where we are seeing it at, that is the asset quality, the ratio of NPLs to gross loans at about 14% is more like what was anticipated at the beginning of the year. So now we are looking at a possibility of really a turnaround in that. But then, of course, as we consider this, there would be options going forward with regard to how credit would actually be extended. So that, in a nutshell, is really where the banking sector has gotten into, and with regard to the key ratios and also the asset quality. Thank you.
Thank you, Samuel. I think we'll come back to a question about the restructured book, about 1.4 trillion. But to Mr. Job, what from the manufacturer's perspective, what has been the key emerging issues and trends that are expected to shape the industry in the next couple of years?
Thank you so much, all the participants on all the protocols observed. We really appreciate this conference. It's quite enlightening, even to us as the panelists. We have picked a lot because we would like also listening to other sectors and how they are performing. From the manufacturing sector, we have gone some steps, or we have come stages from when the first case was announced in the country. That was around March last year to date. We saw a depressed manufacturing sector in the first 3 months. That is between March and June last year. But from June coming onward, we saw a strong and emerging sector because of various opportunities that are coming up during that period, and also because of repurposing of the manufacturing sector. If you're talking about the categorization of essential and essential goods, we saw all this happening. And indeed, we worked so closely with the government so that we can overcome the challenges that we faced then. If you're talking about the lockdown that affected the movement of goods from one industrial hub to the next consumption hub. If not that, if you're talking about the curfew effect, whereby the movement also was curtailed of the workers. And we had to come up with protocols to help us overcome some of these challenges. And subsequently, some of the workers, we had to set them home so that from there, once they have the right infrastructure at home, they are able to work so that we could also be able to maintain the social distancing and so on. So we have seen emerging and nascent opportunities coming up. You're talking about the import substitution strategy during that period because of the disruption of the global supply chains. Because we saw where we source our intermediate goods, or even where we source the raw materials, where we source the industrial machineries and industrial spare parts. All this was disrupted, and we saw a resilient sector within the country that was willing to support the continuation of the manufacturing process. And that's why now we saw upcoming sectors in the country. When you talk about the IT sector, if you're talking about the furniture sector, and many others, if you're talking about making of the beds, even the personal protective equipment. All these were sanitizers, talk of what falls within the PPE category. So we have seen emerging and nascent opportunities, which we are in discussion with the government at the moment, so that we can see how we can sustain them. We don't want to get into the stages where the micro and small enterprises or small and medium enterprises, they have a lifeline of about 2 or 3 years, and after that they have collapsed. We want to see how this can be sustained. But again, it cannot only be sustained from the private sector perspective. It needs also to be sustained from the government perspective. Today, we are talking of a resilient sustainability strategy, which we have worked again together with the government, but majorly with heavy contribution coming from the private sector, especially the manufacturing sector, looking at how we can flatten the curve completely, looking at how we can have the support to the SMEs, looking at how we can have fiscal consolidation. It was a heavy discussion today. When you're talking about the GDP to debt ratio, when you talk about the fiscal deficit 3% as it is enshrined in the EAC Monetary Union protocol. There are all these strategies that we are looking so that through these we can see the reduction of the interest that the government is paying towards paying debts, and subsequently this can be channeled into liquidity of the country, and subsequently when it's channeled to the liquidity of the country, we'll see a robust multiplier effect within the economy that is beneficial to all those who are subscribing to this economy. So we have the resilience strategy that we're discussing with government at the moment, and want to see how it can sit within what is called economic recovery strategy that the National Treasury is working on. Going forward in future, we have various steps that we are looking at, because we want to look at the value chain robustly. We want to look at the backward and forward integration robustly. If you're talking about competitive, one of the pillars that we're looking is competitive and level playing field going forward. We want to see a heavy reduction in illicit trade, because like now during that period, because of the global value chain disruption, we have seen various sectors benefiting, because what was otherwise coming in as illicitly traded, talk of other invoice goods, talk of other declared good, talk of counterfeit, contrabands and whatnot, all these could not get through into the country because of the global supply chain disruption. And subsequently, we saw the non-essential and essential manufacturers benefiting out of this. So we want to see a heavy reduction in illicit trade. If you're talking about the cost of power, looking at how it can be reduced from 0.16 cents US dollars per kilowatt per hour to 0.09, which is globally working for other manufacturing hubs which are subscribing to global competitiveness. Remember, today we have heard a lot about the global competitiveness. The second pillar that we're looking at is the market access. Not only looking at local market access, but also regional and also international. Local market access, looking at how we can have an entrenchment further over Buy Kenya, Build Kenya. What is locally manufactured is being consumed locally first before we consider what can be imported. And subsequently, you see heavy circulation of the shilling within the economy, and many jobs and investments are created. And also the nascent and emerging opportunities that I talked about earlier will benefit out of such initiatives by the government and the private sector. Regional front, we're talking of continental free trade area negotiations and the completion of the same, all the trading instruments and agreements, talk of the rules of origin, talk of trade liberalization, talk of online payment platforms and whatnot. All these, we want to see it getting completed in the course of this year, because we have seen during the pandemic, heavy market opportunities that are coming from the region, talk of from Southern Africa, talk of Central Africa, the PP production, we could even get opportunities of supplying these into such places. International scene, negotiation between US and Kenya, that's another market opportunity because of our robust manufacturing opportunities that are coming in the country. Talk of implementation of the UK, Kenya just concluded negotiations or agreements. When you're talking of a continental free trade area, once all these market opportunities have been finalized, you see that along the supply chain or along the forward integration, the manufacturing sector is going to benefit. The third pillar we are looking at is institutional and policy stability. We have seen some instability of policies during that period. For instance, the tax policy has seen some disruption. If you're talking of the minimum tax that was introduced during that period, that is going to be disruptive to the private sector because of the startups, because of those who are making low margins, but they have high turnovers. When you're talking of the loss-making companies, we saw the reversion of the tax incentives, even when the COVID is not over. So we are looking at how we can have sustainability around that area. The fourth area that you're looking at is around the SME development, market access, governance issues. When talking about access to credit, we can see the Kenya Bankers Association, which we have been discussing around this area. And now the fifth one is resilience and sustainability strategy for the sector within the country, encompassing the greening of our processes, looking at how we can repurpose the plants that are not operational at the moment so that they can do something else for the economy, for further creation of jobs and further investments. Thank you.
Yeah, thank you, Job, for those insights. I think we'll come back to that in terms of how it all ties into the 15% government target contribution from manufacturing to the GDP. And back to Joyful, I think there's one question here that resonates with the young and digital savvy investors from Titus Kinyui. This was a question that was basically addressed to Mr. Kiprono, the chair. He's saying that, Titus saying that the NSE losing young investors to global platforms that offer a wider array of assets with high liquidity. Cryptocurrencies has also managed to capture young Kenyans' attention, and this has made the Kenya Binance community grow exponentially. So being a trader and investor in various markets around the world, what is being done to make the NSE attractive to the next generation of investors?
Thank you very much. I think that's a very good question, and really speaks to how we are repositioning NSE to capture this market segment. Now, we have clearly defined how the youth fit within our investment segments. And one thing, the characteristics of what we have actually been able to come out with is that these are momentum investors. They desire to invest in a very easy manner through the access of digital devices. They're very, very savvy with a lot of information and data that they need to receive real time. So based on those characteristics, we have actually developed or reframed our product offerings to achieve those objectives. Let me just give a few examples. So if you look at our equities market, now we are introducing day trading. And what will day trading do? It will enable investors buy and sell a position multiple times. What that will achieve you is that using very small spreads of cents, investors can buy and sell during the trading period, and then allow for the end of day process to go through a net settlement cycle. So you'll be able to trade one position more than once, unlike what you have today, where you can trade and then you have to wait for a 3-day settlement cycle. Now that's going to be very, very helpful. So that's going to bring the desired momentum and also enable us improve our turnover ratio from the current 7.97 to 15%, which is one of the key achievements that we need to achieve to take our market to the next level. Secondly, we brought a product like derivatives that allows you to trade on on a two-way market. So depending on how the view you've taken on a stock, you can either buy a sell contract or a buy contract. So you're able to make money both ways. And I think this is something that the youth are very, very interested in. And we're sure we're going to achieve that with the introduction of this product. We have also brought you alternative products like the ETFs, which are not the standard equity products that you're used to. And that should help you also invest in other asset classes. And there are going to be more ETFs coming to the market. ETFs are not only less volatile assets, but they're also very affordable. And hence, for an exposure in an asset class like gold, you're only paying about 1,200 per unit, and or now it's about 1,800 per unit. But again, these are asset classes that the youth are identifying with. In the equity market, we are broadening our issuer base. So you are seeing new companies coming to the market. The more recent one that we brought was Homeboys, which very shortly will be issuing new shares in the market. And we're going to be focusing on more tech-based companies where the youth have a lot of interest in. And that's going to be another area for us to achieve. Over and above that, we've done two critical things last year to bring this market into the exchange. One, we've launched the NSE Digital Academy. And we believe that financial literacy is very critical. So our programs are all going to be mainly going to be online-based, allows you to understand what our product offerings are, how the markets trade, how do you analyze various asset classes that you invest in, and all this will happen online. And again, they are the target market for the Digital Academy. We have revamped the app, the NSE app, that now is not only just providing you trading information, but a lot of news, a lot of market information, corporate actions, and things like that. And then we've partnered with a company called Chelasoft to introduce what we call the chatbot that allows you to look at your portfolio on a real-time basis with all the brokers who have signed on to it. So for us, a youth is a key constituent of our forward strategy, and hence I can assure them that into the future, we are going to be focusing more on that and addressing and really providing asset classes that resonate a lot with them. Thank you.
Thank you, Jeffrey. Back to Samuel about the 1.4 trillion restructured book. What is the outlook for this book, and how is it going to shape the banking industry in terms of how they go about their lending activities, and in terms of also recoveries? How is this going to be in the next couple of years or months? Thank you.
Thank you. I think just a recap on what I had said earlier is the 1.4 trillion restructured book is, as I mentioned, is close to half of the entire loan book of the banking system. And if we look at the sectors that are projected really to be affected strongly by the pandemic, these are the same sectors that have actually seen most of the loans restructured. Because if you look at us at close to the end of the last, we're looking at personal loans taking up about 22%, and then trade, manufacturing, and real estate taking up double-digit portions of this loan book. So the outturn of this loan book going forward will really depend to a great extent on the pace of economic recovery, because if it's tied to the effects of the pandemic, then as the economy kind of unwinds and we are starting to see kind of a return of activity, then the pace of and the need and requirements for further restructuring will actually also go down, and possibly even a reversal of the loan book towards a stronger repayment plan. Just to add on this is really to also assess the fact that in this loan book restructuring program, we've seen close to 88% of banks really across the different tiers considered restructuring. And so this is kind of a systemic, it's a systemic need that, of course, as you look at it, then you would be tying it closely with the entire economic turnaround that is actually happening. But most importantly also is to focus on the issues of which sectors were really in demand of this restructuring. If you look at the proportion, close to 60% of the loans that were restructured were actually to MSMEs, and about 30% to the big corporations, which were actually directly affected by the pandemic. So a return to activity by MSMEs and the big corporations as we look up to a recovery of the economy would really turn this around in a way that would see kind of in the next quarter or so, we will be seeing a turnaround in this in the credit performances. So, and also if you look at the need for an assessment of the need for restructuring, you would see that about 86% of the loans that were actually restructured were in terms of the extension of the tenor as well as the interest servicing. And most of these, again, were happening, about 2/3 of them were over a period of 1 year. So beginning from March to October, all the loans that have been restructured so are likely to actually see a reversal in the next two quarters. And of course, it also would be contingent on the measures that would be taken to really revamp economic activity in the near term. So as I tie this to the economic turnaround, of course, it would be of interest then to consider that at the moment, with much of the loans that have been reclassified, restructured, against the uncertainty that still continues to prevail with regards to the pandemic, the default would be for bankers would be to really continue tightening the credit standards unless something is done with regards to how credit is priced. And this allowed me to expound a bit. And if you look at the preconditions that have been stated by previous presenters, is the National Treasury has put in place a very strong, they say 8-point turnaround in terms of revamping economic activity as a recovery strategy. And with this, as is mentioned by even colleagues from the presenters, I think it was the chair, NSE, and now Jeff, is a mention of the need for liquidity in the market, mobilization of resources that would then finance economic turnaround. And this I would tie with the prospects for economic turnaround against what the economy looks like at the moment. Of course, we have had the picture on the fiscal side in terms of the narrowing of the room that the fiscal side would have in terms of boosting economic activity. The monetary policy side, in as much as have actually put in place a very strong signals and reductions in the CBR and CRR, you see that there has been an exhaustion. Close to 94% of the funds that were actually made available on the CRR adjustment have actually been utilized. Now, the CBR, as was mentioned briefly by a previous speaker, Jared, is that it really depends on the transmission, which now comes with lags. And as these lags are in place, there would be need now to look at other additional measures that could actually be deployed for purposes of kind of re-energizing the pickup in credit. And that would mean really providing a conducive environment for an effective pricing of risk, so that the credit then can be extended inclusively to the segments that have previously been kind of curtailed because of the risk considerations. Because in an environment of uncertainty, then there would be need to effectively price and appropriately price risk. And that calls for an enhancement on the program for risk-based pricing. I know this is a pillar that the central bank, together with the banking sector, have actually agreed on in the banking charter. So kind of reigniting the levers for effective pricing of risk, so that then the segments of the economy that need to be effectively priced can actually access the much needed credit for purposes of revamping economic activity. So yes, with regard to go back to your question on the loan restructuring, again, that would closely be tied to the pace of economic recovery that we all anticipate will be picking up. Thank you.
As we wind up, Job, the 15% target, government target to manufacturing, what's the way forward towards this? Are we achieving it? Are we underachieving it?
Thank you. Indeed, as far as the government target that we have set together of 15% GDP contribution by the manufacturing sector by 2022, which is just next year, seems impossible because as this was set during the Big Four agenda setting in 2018, which also sits in the Kenya Industrial Transformation Program of 2015, also Industrial Policy of 2012, Guided to Vision 2030 of 2007. All these, they have been trying to achieve the 50% GDP contribution, but it has been elusive. If I would give the statistics for the last 3-4 years, we have dropped from 9.4%, 9.2% to 9 to 8.4%, and currently we are at 7.7% GDP contribution by the manufacturing sector. But on the reverse, you see that the actual value add in terms of shilling has been growing, but marginally, from about 500 billion Kenya shillings worth of value add. If you look at the economic survey of 2018 to around 2020, to the current 715 billion Kenya shillings. That means within a span of 3-4 years, we have seen a value add increasing. But this is because there's some other sectors that are growing faster from the 100% pie that are growing faster than the manufacturing sector. You find the service industry, the agricultural industry, or the telecommunication industry, they are growing faster than the manufacturing sector. And subsequently, that's why there is a slide on the percentage GDP contribution. We are looking at how we can move at the same pace with these other sectors, with a few issues being considered along the way. And especially the much talked about global competitiveness. Because you cannot compete in the manufacturing sector or grow faster than these other sectors that comprise the economy if the global competitiveness has not been infused in your processes. We are talking of inbound processes. We're talking of in-factory processes and outbound processes. For instance, if you're looking at outbound processes, the manufacturing sector has been undergoing, just like any other person in the private sector, multiple fees and charges when they are moving their goods from one point to the other. The county government has become a menace to the trade. And this is going against the provision of the Constitution. I think it's Constitution clause 209 or 109 that's talking about that the county government should not become an impediment to trade. But now they have become because of multiple fees and charges. In factory processes, if you're talking of the cost of power, which I talked about earlier, or even when you're talking about the labor cost, when you're talking about and many others, many other things that you find that they are falling within the in-factory cost. And then the inbound processes, we have a costly SGR transportation, or even sometimes it's delaying. You find that members have to pay demurrage and storage costs because of the delays that are coming along the process. So we believe it's possible to get to the 15% GDP contribution, but there are various steps that we need to work together between the private sector and the government and various other stakeholders, especially to infuse competitiveness in the process and ensure that there is fair trade, fair international trade. I mentioned earlier over the illicit trade that has been hurting the growth of the manufacturing sector in the country, and especially when talking about the valued, the invoiced, illicitly traded goods, contraband, counterfeit. All this has had an effect as far as the costing and the pricing is concerned. So you're looking at how this is going to be addressed going forward. So 15% is possible, but if we are doing monitoring and evaluation today of where we are, because we thought by this year we'll be at around 12% GDP contribution, or if you're talking about the actual value add, we'll be at $1 trillion plus. We are not faring well, but we believe still we can get there.
Thank you, Job. I'm being informed that we run out of our time. Maybe in closing remarks, Jeffrey, a minute somewhere on Job. Thank you.
Thank you. I think it's been a very nice contribution and just getting to hear the perspective of the different sectors. And likely, mine is just to make another very passionate appeal to the market that investors, that the Kenyan market is very attractive. You've heard about the predictions from the various analysts provided today. We are focusing on growing the size of this market, and I know we're going to be working very closely with you to increase the number of companies listed, increase the domestic investor participation, speaking to all the sectors to look at the market. We have various platforms that can help you begin your listing journey. If you're a startup, you can join the Booker program. If you're ready and you're still an SME, you can join our GEMS program. And if you come to the main market, you're able to get capital. So we have positioned ourselves as a venue for capital raising. And as I hear the conversations from the manufacturing sector, I think we are really open to an engagement to see how we can support your capital raising initiatives and help the sector actually achieve its objectives of making a major contribution to the economy. So mine is to just assure that we have a very stable and robust and strong market, a leading market in East and Central Africa. And hence, we believe that bringing all these stakeholders into the same venue, we'll be able to achieve our aspirations of making Kenya and Nairobi a really international financial center. Thank you.
Thank you, Jeffrey. Samuel.
Well, thank you for the discussion, and again, appreciating the perspectives from different speakers. I think in concluding remarks, it's really just to appreciate the fact that and reinforce the fact that the banking sector remains stable and very resilient, that it has weathered the storms, it continues to weather the storms, and is now ready and well placed and positioned to really support economic activity, particularly through an expansion in the credit. Of course, without losing the cognizance of the fact that the banking sector would really like to grow credit without compromising on stability considerations. So any engagements and any discussions towards enhancing the pricing of risk would really is a consideration at the moment, and of course looking forward to economic financing of the economic recovery path. And I must appreciate that every sector is actually looking at increasing mobilizations of resources towards revamping economic activity. And now, as we look at that recovery, we are also looking at a consortium of policy measures that can actually be deployed, both from the fiscal side, from the monetary policy side, and of course, the supporting measures that would now give the banks the levers to really grow their credit and support economic activity. So thank you very much for the opportunity again.
Thank you, Dr. Samuel. Finally, to Job, closing remarks.
Thank you so much. As I earlier stated, our interest is to see how we can drive the global competitiveness of the private sector, and especially the manufacturing sector. The study that you have carried out is showing that we're at around 12.8%. Our interest is to get to 0% so that we are globally competitive. Something else we're interested to see us working together on is the import substitution strategy. The statistics shows that we have a trade deficit of about 1.2 trillion Kenya shillings because the exports are starting at around 6.5 trillion, and then it gets to the imports at around 1.7 or 1.8 trillion Kenya shillings. Export is billion, or it's 650 billion Kenya shillings. So in this, our interest is to see how we can drive further the exportation by 25% as it is enshrined in the National Export Development and Promotion Strategy, and subsequently see heavy consumption of what is locally manufactured so that we can see the reduction of this importation in a fair manner. We, or Kenya Association of Manufacturers, we have various arms that are working together in achieving this. We have the academy that is spearheading the training of the industrial captains or industry captains. We have the SME hub that is looking into the SME growth or MSC growth within the country. Center for Energy Efficiency that is looking at how we can be as more efficient as far as the consumption of power, consumption of water is concerned. So it's us to take advantage of this going forward so that we can drive the global competitiveness together. And also would like to note that we are in a catch-22 as a country because we are facing what I would call a trilemma situation, not a dilemma, a trilemma situation because of heightened political activities, because of COVID pandemic, and also the dull performance of the economy. If we can have a good mix that is going to look at how this trilemma can be overcome, then it's going to serve us going forward and ensure that there are more jobs that are created and investments are flowing into the country. Thank you so much.
Thank you very much, our panelists. We really appreciate the wealth of your input and insights into our playbook. And for the digital investors out there, we have our app called Jikuze. You can open an account and start investing in both equities, bonds, and unit trusts, and start that investment journey. It also tends to include our weekly investor strategy that has trading ideas on a weekly basis. So back to the MC.
Thank you so much, Gerald Morioki, for moderating that session, and even for the earlier conversation on the equities market through the research that you have been doing. And many thanks as well for the weekly webinars that you do on the equities market as well that are followed. And of course, many thanks to our panelists, Geoffrey Odundo, CEO, Nairobi Securities Exchange, Job Wanjohi, Kenya Association of Manufacturers, and Dr. Samuel Chiriongo from the Kenya Bankers Association. Many thanks, gentlemen. Right about now, because we want to really be up to the scheduled time, we're headed to the final panel discussion, which is quite a vibrant one because this one involves us discussing matters retail. And of course, the subject is the 2021 landscape for the retail investors. We have had sentiments from the Nairobi Securities Exchange, courtesy of the chairperson, as well as the CEO, pointing out to the fact that this is one of the key pillars for driving the markets this year and even moving forward according to their strategic plan. And so what is in store today? We have an amazing panel that I'm just going to mention by name and title very quickly because of time. First of all, I would like to acknowledge the moderator here, Kevin Gige, who is already seated right here next to me. And of course, we have the financial risk analyst, Mir Rakar, and we have the CEO Trading Room, Felix Ucheng, and then the CEO Kenya Wall Street, that is Eric Asuma. And then we have Robert Ocheng, the financial literacy champion, and Mbithe Mwema, CEO Infallible Group. Many thanks, panelists, for keeping along with us, and we are looking forward to this final amazing discussion. Sometimes they say you save the best sometimes for the last, so I believe our moderator is up to the task. Kevin Gige, the floor is yours now.
Thank you very much, Maina. Again, my name is Kevin Maina Ngige. I work with Genghis Capital, a trading participant under the Nairobi Securities Exchange. I have roughly 10 years experience in retail, institutional, and foreign trading, predominantly here in Kenya. So my panelists, as introduced by Maina, will be hosting these 5 panelists: Mbithe Mwema, Robert Ocheng, Felix, Mir Thakar, and Eric Asuma of Kenya Wall Street. Our segment, I think Gerald stole the light from our segment, supposed to be the most entertaining yet, having to be interactive, and you're going to cover mostly stuff to do with retail trading. You might be aware that in Kenya, I saw from Mr. Kituni on the previous presentation that retail participation in the local market was averaging at 13%. We thought that would be a bit higher, maybe at around 30%, but due to the pandemic, we've seen that being eroded. If we compare this to Pakistan, for instance, where retail participation is 92%, with a contribution to GDP of 49%, I think our market capitalization as a contribution to GDP is an odd 24%. So we are going to jump into, I'm going to start with the lady, Mbithe Mwema, to just give us her opening remarks regarding retail trading. Mbithe, the floor is yours.
Good morning, everybody, and thank you so much for this opportunity. I think this is a brilliant way to start the year, and certainly kudos to the team at Genghis Capital. Kevin, thank you for the statistics that you just shared. 13% in terms of the contribution to the retail sector is pretty low. And I think what aches me as being in the industry and having been looking at this industry for 15 years is the fact that there are brilliant opportunities in this market. And I'll say Safaricom, which is the case in point, where we as Kenyans contribute 100% of the revenues, but in terms of ownership, we are 4% or below. So when it comes to the retail investors, that's literally you and I who are generating profits for these companies. These profits are then being appropriated to external investors. And I think looking at what we are doing today, the discussions that are happening today, we must absolutely change that narrative. But changing that narrative starts with understanding who are these companies, what are the opportunities available for you, and how do you tap into it? Because the focus needs to be, how do you invest for tomorrow? What's your 10-year plan? And how will you be part and parcel of the economic recovery for Kenya? Thank you so much, Kevin, and back to you.
Thank you very much, Mbithe. Right over to Eric Asuma. I see you've already muted. Maybe opening remarks real quick.
Thank you. Thank you for the opportunity to the Genghis team. It's a fantastic opportunity to just tell the market in terms of what's happening in the retail sector, particularly what retail investors are looking at. But my thoughts on what's happening. I think, as most of you know, we're in the industry when the pandemic hit. Major markets across the globe tanked. But then, as I think few months or few weeks down the line, major stock markets, I think some of them began the recovery. And looking at several reports, we saw that major global brokerages reported a spike in new accounts for retail investors, generally because I think they saw an opportunity because of the dip and all that. But unfortunately, I think, as you mentioned, that wasn't the case here locally, not just Kenya, but I think across most African economies. And my view is that, look, it's because of either it's the lack of tech, or we don't have some sort of companies that can attract, or companies that that could ride out the pandemic fears, companies in the e-commerce space, the technology. I think predominantly our stock market, I think, has majorly companies in finance, manufacturing, real estate, and all that. But I think generally, I thought the pandemic presented an opportunity for the retail market, but I think as a country, we were unable to take an advantage of that opportunity. But I still think there's this time to capitalize on that. Thank you.
Thank you, Eric. Right over to Mr. Mir Thakkar, our financial risk analyst and Twitter conversationalist. Thakkar, the floor is yours. Mr. Thakkar, unmute your mic, please.
Thank you, Kevin. So I must admit that I will be taking a different view than some of my peers. And I would rather focus on what has been done and what hasn't been done, rather than what we are not doing enough of. Basically, retail investor participation is quite low in this country, not only as a result of the consumer spending power, but also rather as a result of the losses suffered by many retail investors. We have seen companies like Mumias Sugar suddenly being insolvent, and companies like the national monopoly utility, Kenya Power, which did a rights issue in 2010 at 1950. It's, the share price is now trading at 150, I think, today morning. So we are seeing a complete combustion of value for brands that retail investors tend to engage in predominantly, because retail investors want to see something that they actually use in the stock market, because they understand brands that are in their pockets, in their sockets, and they want the stocks to rocket. So I think we need to look at why we have, to not use a euphemism at all, a lot of zombie companies in the stock market. Thank you.
Thank you, Mr. Thakkar. I think we'll be getting back into that in depth, but right about now, I'm going to give the floor to Robert Ochieng. The floor is yours.
Thank you very much, Genghis Capital, and everyone for being here today. So I think this is a good conversation, because what has been happening in the stock market, to be honest, you've created an elite people's club. And let me give you a good example. It's like you are in your house and only the mother and the father talk. So I'm glad that for the first time ever, you've given a consideration to people who are actually dealing with retail investors. And believe you me, outside the big offices that we sit in, we have a lot of information about these people. People in diaspora, the chatters at midnight, the chatters in the morning, they're always wishing that you could engage them more, and even local investors. So I hope that we can just do away with the word retail, and you see investors as partners. They are your partners. They are the people who give you your bread and butter. So going forward, let's start seeing them that way, because that one will lead to more consideration in terms of serving them, not as an afterthought, because my background is in data, and the current millennial, they're going to witness like the biggest inheritance ever in the world. So I don't know if any brand wants to have a strategy, and I'm very glad that today we are having an engagement because it's part of the team. Then finally, to be honest, finance is being consumed by over 7 billion people globally. And we are not interested in being BCom or CFA, just deliver the information to us in our language. So I think for the legal fraternity and financial markets, people tend to speak as if they are in class. So talk to us in our language and we'll reward you with our pockets. Thank you.
Thank you very much, Robert. I think we're going to get back into that data on foreign individuals, or rather, as you call them, the diaspora. From Mr. Kitoni's statistics earlier on, we saw they contribute an average of 1%. So we'll talk around that and how to build that. Right about now, I'll introduce Felix Ochieng. Floor is yours.
Good morning, and thanks a lot for the team at Genghis. I think this is it's a very wonderful forum that you guys are bringing in together today. And I'm glad to be part of this panel. It's also very interesting that the panel 3 really comes from guys who are very vibrant and still people who are within the youthful age of the investing. We've seen data that came in, I think, mid last year as well from CDSC indicating that the age group for those who are investing on the market for retail individuals, you find the older people getting into invest onto the market, and that comes in as a very, very huge challenge, mostly to the youth. So even as we look on investing on the retail space, I think it would be better to start having a discussion. I believe something that Robert has mentioned that comes in very handy as well is retail investing has always been seen as a select club members. So I believe even as we go into discussing the retail market, it would be very important that we see on how we can bring in more vibrant youth to look onto the investing space. So even as we go through this discussion, I think that is something that we'll be able to discuss, and I believe that we'll look into that as well. Thank you.
Thank you very much, Ochieng. Right about now, we are going to talk about factors influencing investment decisions. And maybe just as a rough background, I was looking at data, first and foremost from India, where age and gender has been the biggest factor contributing to making investment decisions. When you hover over to our neighbor Nigeria, performance of the stock market, expected stock split, dividend promises and bonuses, and expected corporate earnings. In Kenya, an interesting statistic is that influence from friends and popular opinions of a trend is the number one factor influencing individual market participation. So, Madam Mbithe, back to you. We've seen this NSE CEO Geoffrey Odundo talk about things to do with day trading that they're introducing. They'll talk about direct market access. What, in your opinion, do you think is one of the biggest factors that will boost retail participation in our local markets?
Thank you so much for that question, Kevin. I think I'll answer it in two parts. There's the element of access to information. So I have been looking at the Kenyan market and dealing with institutional investors. So as an institutional investor, the access to information is relatively easy. I've worked with a brokerage firm for the longest part of my career, and information was so easy to get. I'm on this other side engaging with the retail sector. I get that information courtesy of my networks, but for your regular retail investor, it's considerably hard to get basic information. What is happening in the market? What are the prices yesterday? How do I access this information? If I don't have a brokerage account, or if I have a brokerage account with a broker that doesn't have an online trading platform, then I don't quite know. And I put this in perspective, Kevin, because on the flip side, if I'm looking at US equities, if I'm looking at FX, if I'm looking at Bitcoin, there's so many platforms that give me so much information that there's literally an overload of information. And if I wanted to trade, that either analyze this information and assimilate it, or I could be able to get a professional to help me. That's not the case when it comes to Africa, when it comes to Kenya, but I think the COVID-19 pandemic has actually opened up opportunities. So I think there is an opportunity and a challenge, and I appreciate what the NSA is doing with its My Mobile Trading platform, where you can see more information. So there's an opportunity set just for the vibrancy of the information. And then I think secondly, there's also an element of the cost of access to some of these opportunities. So if you asked me, the retail investors today, the people who are below 35 years and below, are already investing globally because of access to information and quick access to trading platforms. So even as we are introducing day trading, the element of access to information has to be really improved, and access to visibility of historical information so that you are making an informed decision. And I think also an added element of corporate access. I think for the longest, corporate access has been relegated to the institutional investors. And what everybody on this platform is saying is there is a voice. Let me put it into perspective and close on this comment. The fact that in the month of December, 3.2 billion was brought back into the country by the diaspora. Can you imagine if 10% of that was able to find its way to the NSE? In other words, if there was clear visibility of these companies, who are they? How are you interacting with them? If there was better information asymmetry, then I think we'd be in a much better place. And I think there is that ongoing opportunity of financial literacy in terms of trying to appreciate and create awareness of these opportunities. Thank you, Kevin, and back to you.
Thank you very much, Mbithe. Over to Felix Ochieng. I'll jump right to you. Mbithe mentioned stuff to do with access and cost of access to information and cost of access. Playing the devil's advocate, we as Genghis do send out newsletters and daily information to our clients, and I believe most of the other brokerages do, as with the Nairobi Securities Exchange. These per se don't seem to boost the retail participation as we would hope. Any other comments on how to boost on this?
Yes, I think it's very important to note that you see the main challenge that I think the investment banks and the NSE does is that we do not put, whenever we have our reports go out, these reports are put out so as to face on the technical aspect. An example is a retail investor, some mamamboga who you'd want to invest on the NSE doesn't really understand the technical bits of how the market is performing. A mamamboga somewhere else doesn't understand what a PE ratio would mean to a stock. So how is it possible that you guys can bring it to the least what's possible, the least terms? So once again, that also pushes back on financial literacy, where we need to put in and ensure that the least person, whenever we send out these reports, and I'm glad I received the reports for Genghis almost coming in, and also for the ones from the exchange as well. If the NSE sends out the NSE weekly, whenever the Genghis sends out the weekly the weekly review, and all these other investment banks, you're always finding that all these need a little bit of a technical know-how. If you want to start investing as an individual investor, for any investment, a simple thing is if somebody wants to buy land, you're always told something very basic. Buy land, it will appreciate. How will it appreciate? Land appreciates over time. You'll be told this is going to be a prime area. So how comes for the stock market we have to bring in all these jargons? Could we have reports that whenever we are going to have a few individuals, we have a certain report that yes, we would target probably the fund managers and the investment savvy individuals, but also we can also start producing reports that somebody can read, just the same way we read political news on the newspapers. Can we start having discussions where we target the least knowledgeable member of the community so that they can be able to understand and read these reports? I believe with those, we can always be able to bring in a lot in terms of activity. I know there are people out here who have a lot of disposable income. A few days ago, we were having a discussion with a fellow panelist here, Eric Asuma, and we mentioned that you'd imagine what would happen if there's somebody who works out there and has 300 to save on a day-to-day basis. If you can tell them that bringing this money to the stock market, giving them basic principles of investing without having to sort of quote unquote confuse them on the market, how much do you think that is going to earn? Not only for them as individuals in terms of shareholder returns, but also in terms of the exchange, growing the market as well. So I think that these are some of the things that I believe we can be able to look at as the market.
Thank you very much. Felix, over to you, Mr. Mir Thakar. You have a wide following on Twitter, and I'm sure part of the some of the questions you've encountered are what do I invest in the local market? What stock do I buy that in 2 months will multiply my investment? Or rather, is Bitcoin a good asset class? Or do I still go to land and real estate? How do you tackle such questions, Mr. Thakar?
Well, the general idea that I've gotten from such questions is that investors want fast-moving returns, something they can buy today and sell in 2 months with 50% return. So that's why my perplexing dilemma as to why stock like, say, Kenya Airways has been suspended. That stock went from 1 shilling to 3 shillings in a number of months. And people who bought, say, 1 million KQ at 1 million shillings were sitting on 3 million, just like that, out of thin air. Even Bitcoin was underrated. And I think Bitcoin could not give such returns as well. So as for suspension of stocks, in an arbitrary manner, I would say that's my first concern, because a lot of the queries I get do go around fast-moving investments. And secondly, I do get queries about, Occam's razor types of investments, you know, the simple type of investment, like say Safaricom, KCB, Equity. Like I was looking at Equity Bank's provisions in Q3 2020, and I imagined that rather than increasing 8 times as they did, had they just doubled, then the company would have reported a 24% increase in profit. And doubling provisions is not a small thing as well. Of course, 8 times is something that's mind-blowing. But I was looking at this and I found that sometimes the simplest answers are the right answers. So KCB, Equity, Safaricom, these stocks are something that investors consider no-brainers. But overall, what investors want is a long-term uptrend. And you know, some of the policy actions like the interest rate cap in 2016, introduction of ill thought out and not well communicated capital gains tax in 2015, these actually affected the market from attaining a long-term uptrend. And I think the damage has not yet been done away with. The NSE 20 is down 66%. And that's from 2015. But from 2007, it's in a secular bear market because it hasn't achieved the highs of 2007. And the 1.9 million retail investors that we have in Kenya are also not quite happy about such a situation.
Thank you very much.
Thank you, Kevin.
Thank you very much, Mr. Thakar. Over to Eric Asuma. Eric, you're the CEO of Kenya Wall Street, one of the leading platform in distributing news to most of our retail investors. What are your thoughts?
Thanks, Kevin. I think I'll echo what my fellow panelists have said. I think one of the major challenges that we have in this market is financial literacy. So I always wonder why do Kenyans invest in, when you look at, Kenyans will easily invest if you tell them, look, put money here. They don't know what's the underlying asset of that particular, let's say, investment scheme. Can call them scams because they are promised high returns. Why should Kenyans, a good example would be, I think, when you noticed during the last year, several reports that Kenyans put a lot of money, either they had a lot of money in hand, or they had put a lot of this money in money market funds. I'm just wondering why could this money not be channeled into the stock market? And I think the two key drivers are lack of financial literacy, a poor financial literacy, and the other one I think is our market we haven't really taken advantage of technology to expand the market and enable, let's say, fintechs to build products around the stock market. So if there was an easier way for the stock market or for the industry to generally see how do fintechs plug into the stock market, and without going through the tedious and vigorous process of, let's say, being a broker or even licensed institutional partners like Genghis and other banks or brokers, easily enabling their system to connect with fintechs to expand the market and bring so many people on board. From my experience or from where I sit, there's such a huge interest in terms of people who want to access some of these opportunities. But then when you ask them, what's the challenge? The biggest challenge is how do we get access? I think we still have a problem with regards to even opening a CDS account. In as much as you say we've digitized this entire process, for even an account to be approved will take days, follow-ups and all that. I think we still have a big challenge in terms of how do we embed technology into our stock market. I think the NSE has done a good job so far in terms of upgrading the systems, but I think we still have some work to be done. So I think as I close, it's about financial literacy and how do we enable tech to democratize our stock market.
Thank you. Thank you very much, Eric. Mr. Robert Ochieng, just to take a detour, an interesting question here. I have 2 plots in Kamulu. I'm getting 12% in dividends from my SACCO and a 7% fixed deposit at the local bank. Why should I invest in the stock market?
So basically, I think the missing link has been in terms of information and letting people know that money is something that is very sensitive. I usually say that money is a silent life partner. So you are not going to learn about financial literacy in a class. So that school kind of thing won't work. We need to be in communities, just like people interact in golf clubs, in churches. You never go in a church just for a day to be spiritual. So who said that for financial literacy, you're supposed to go in a class, come out of it, and you're done. So once people understand the value chain of personal finance, because to be honest, investment banks and brokerage firms, they're disadvantaged because they don't do the real work, like the groundwork. Because if you meet me today and you tell me to buy shares and maybe I don't even have an emergency fund, you are disadvantaged. But if you can take the pain of walking the journey with me, then I can be part of what you are offering. Because I know that now I have an emergency fund and have some circle investments. I need now to graduate to some form of investments that have got high risk and maybe they promise high returns. But if that link is missing, whereby everyone is just sitting in silos, but you want part of my income, then I'll just go to safety. It is human nature to go to safety. And of course, with misinformation, the stock market is disadvantaged because we are already being promised like 20% from Bitcoin and other scams. So in terms of information, it is to your advantage as NSE market players to ensure that people are educated. And the reason why I don't want to use the word financial literacy, we don't want to define terms. Let it be a journey, because if people missed this, like in terms of learning about finances, financial literacy will work for only those who are in school. For us adults, we are in productivity era. Give me something that is actionable that I can go and do and help me. I don't want definition of terms and P ratios. So that's the missing link again. So even as market practitioners, let us also learn to tell people things that we are doing. So if it is investing in the NSE, you know, if you've done it, the way you'll tell someone is totally different, because like Erica said, opening a CDS account is, I don't know, is like one of the 1,000 ways to die. People have to call brokerage firms and ask for help. So you wonder, like, this industry has got millions of people. To be honest, what do they do? That's the experience that retail investors have. So for adults, let's have a different approach. Actionable insights. We are in the productivity era. We already waste a lot of time on traffic and so many things. So for finance, let's have something that I can do and see results or have an experience as fast as possible. So if we can remove the frictions in terms of opening accounts, in terms of bringing information in a very relatable way. Like Safaricom, when I wake up in the morning, maybe I have my phone, that is Safaricom. Then you can tell me to go to Kenya National Bureau of Statistics by myself and see how things are playing on in Safaricom. It should not be like there's some genius sitting at a brokerage firm telling us that go and buy Safaricom. It has to make sense to me as a retail investor. So, and when we are partners like that, in a golf club, there's no one who is senior than the other. In a church, everyone is friendly. Even the priest is friendly to people. So let's go about it that way. So that's the best I can offer today. Thank you.
Thank you very much, Robert. Mr. Felix Ochieng, we've had much talk around CDS opening and how rocket science it has been. Maybe you can take us through that process for those who might not be aware of. And as Genghis Capital, we have our equities model portfolio for 2021, where we have our momentum stock, our value stock, and our income stocks. How then, for a retail investor, do I decide what to buy when getting into the market if I lack this access?
Thank you once again, Kevin. I think we need to, let me just first explain the process of opening a CDS account, and probably maybe the attendees as well will understand why Robert is saying that this is a very tedious process. Before you set up a CDSC account, there are documentation that you need. I think there are about 4. You'd need you'd need your national ID, you'd need your KRA PIN, you'd also need a utility bill payment, which nowadays a few investment banks would accept an M-Pesa and a few, and also you need also a passport photo. As we go through tech, we know there are certain accounts and certain investment banks that actually allow you to upload this online, where an example is if you wanted to set up an account using some of the, because I know there are a few apps, let me just mention. There's the Genghis app on Jikuze, there's Hisa as well, which brings in where you just take a selfie, you upload it, and I know some of them are still in the test phase. The challenge that I believe this comes in is most people don't have stuff like utilities anymore. If you need a retail investor, somebody who's trying to set up their CDSC account as they're on the go, you're in the bus, in the matatu in the morning, and you want to set up your CDSC account, how are you going to do this? Do you have to go to the bank so that the bank will confirm the statement for you? These are some of the challenges. And this is a challenge that maybe I would also pose to the team at Genghis and the NSE at large. You'd imagine it's way easier for you to open an account, and sorry, but this is the most realistic example I can have. If you wanted to open, say, a mobile loan account, an example is if you wanted to take a loan through these mobile apps, if you wanted to open your account maybe on a betting platform, it's going to be very easy because the confirmation on IPRS is almost on instant. Why is it that for us to open a CDSC account, we would have to take this long, where even if after submitting your accounts immediately, if the documentation, you have to wait for 24 hours before you can be able to trade? So this is where tech is really needed. As much as we are working, and I know the NSE has been working on developing the tech, and also generally as a market, I believe all the participants in the market are always trying to update everything with the most recent technology. How can we integrate stuff like IPRS, where the moment you key in your ID number, you're able to open your account on instant? If you go to a bank to open an account, you don't have to wait 24 hours. You'll open your account at the bank within a few minutes, and you can be able to deposit money from the bank. Even your ATM card is being processed there at the bank. Why do we have to wait for 24 hours before you can trade on the CDSC account? These are some of the challenges, and because I know some of these things come in for investors, and investors are missing a lot of opportunities on the market as well. I know that that is a challenge, and I believe that the market players will be able to work through that in the end. So maybe if you just repeat your other question, Kevin.
Thank you very much, Felix. I think pretty much you've covered it. We're going to get on to it. We are seeing a question here from our viewers on how do we become Genghis retail clients. I think that's going to be addressed to you shortly. Another question I'm seeing is regarding dividends, and the question is, I'll direct the question to Mbithe Mwema, and the question is, do dividends offer a better alternative to SACCOs? I think we've covered that much. Maybe if you can cover that in a second or two, Mbithe.
Thank you very much, Kevin. Let me answer the question first of the person who said, I have a plot in Kamulu, I'm getting 14% from my SACCO, and I have a fixed deposit at 7.5. To that person and anybody else looking at equities, in the last 5 months, Safaricom as a stock is already up 40%. It was 26 shillings in the month of August. Now it's over 36 shillings. In that same period, Bamburi doubled. That's 100% return that Bamburi made. What I'm trying to say is you cannot look at the NSE and look at the over 60 stocks as one particular bucket. You have to actually be in and out of the market in terms of being attuned to the information. What happens when you are planning your own financial well-being is if you want to start out on your investments, you want to invest in the low-hanging fruit, things like SACCOs, etc., that give you a regular return. When you make that 14%, why not take that 14% and allocate it to the NSE? Because you will be able to make returns. There are good opportunities there. The outlook is improving. You can make a return. But do this. Empower yourself before you make that decision, because the same way you can make money, the same way you can lose money. Second thing on dividends, you will get dividend yields, but then again, you cannot look at the NSE and say that the entire NSE will give me this kind of dividend yield. You need to be specific and look out for companies that will pay you dividends. What we know today from the discussions earlier today, and also just from our own engagements over the last couple of months, is the fact that the banks will not be necessarily paying you a dividend, largely because they need to be able to preserve capital in light of COVID-19. What does that mean? Look at other companies such as Safaricom. Safaricom has been paying a dividend. Its yield is about 5%, but probably now it's a bit lower because the price has rallied. There are other companies such as EABL that are also paying dividends. So you have to be selective, and Genghis does offer a lot of information. To my final point, Kevin, when it comes to access to this market, I do look at numerous platforms, and I must say that the Jikuze app, which is a product from Genghis, is by far the simplest. Whether it's account opening, whether it's access to information, you do it on your phone, and there's so much simplicity in terms of being onboarded and executing on your shares. And I like the seamlessness in terms of I deposit money on my M-Pesa account, I can execute the viewership of the platform in terms of what is happening on the markets. I absolutely like that. But I have to concur with my colleagues. There's an element of agency and misrepresentation in terms of the access to information. When you go to betting, a while back, these betting companies could go to all TV stations and they could be able to put up their information online. I run a show with Metropole TV, which is a business station. We have a segment on Fridays, which is called Ask Me, and we take you to the street trying to understand what is holding you back. And I always wonder, the regulations of the markets, the capital markets, say that you have to trade through a broker, market access is limited. But we had billions that were going through the betting companies. Why can't these platforms be used? And why can we talk about Safaricom is at this price? Why can't the person watching quickly get on their phone and say, I want to buy Safaricom at this price? Of course, within different boundaries. Because if we don't look at also the regulatory structure and this market structure of this environment and not allow for agents, you won't be able to prosper and people won't be able to get visibility of these opportunities. So in sum, there are opportunities. You can make much, much more on the NSE. You have to be selective. You have to be informed, empowered, and be on the right platform. Thank you, Kevin, and back to you.
Thank you very much, Mbide, for your invaluable thoughts. I see a question on our panel, on our viewers, on how to enroll for the Jikuze app. I think that's going to be addressed very shortly. Over to Mr. Thakar. There's a question for you, Mr. Thakar, and the question is, I live in a third world country with twin pandemics. First is the COVID-19, and secondly is the unemployment pandemic. My disposable income just came under attack on 3rd of January, where the tax funds were increased or reversed to what they were before. How then do I invest in the stock market?
Well, Kevin, I think many people think they need large amounts of money to make investments. You need to invest what you can. And there are sometimes sacrifices that one must make. For example, if you eat out every week, then you should eat out once a month and invest the 2,000-3,000 you have in well-researched stocks. And when I say well-researched, there are actually a lot of Kenyan entrepreneurs that are currently offering financial literacy education programs on innovative platforms like WhatsApp and Zoom right now. So invest the first 2,000 you save in the first month into such a platform. And then in the second month, you can start gradually investing. And when I think about this question, I believe that the investor wants long-term returns. So it's not that they need to hold a stock for multiple years. It's just that when they take profits, they should reinvest those amounts. Sometimes the market may be high. For example, right now, the NSE 20 is under 2,000. So right now you can buy a stock, get say a speculative stock, like I think Mbithe was talking about Bamburi Cement being up over 100% in a few months. So you buy a speculative stock like that, get your return, get out, and then put the money in another undervalued stock, say a bank, because the market is at lows right now. But sometimes you can be buying stocks and then the market starts rallying. So at such a point, it's not that you sell your stocks and buy another stock which has already rallied. No, at that point, you're going to lose everything you made. So when the market has already rallied, you can either look for opportunities that are undervalued, the so-called Pascal's wager stocks, the types where you put your money in and hope that you'll get a return, because they are fundamentally illogical in terms of the price. Or you can just invest in money market funds. Like, for example, Genghis does offer a money market fund service. And then you wait for a while and see if you find another opportunity. You have to be very patient after taking profits. So overall, I think a person needs to first invest in these small scale financial literacy programs. And then secondly, start going in slowly on a monthly basis.
Thank you very much, Mr. Thakar. I see a question from Gilbert Limotsi. How can I invest 1,000 shillings in the NSE? I think that question we've addressed it, Mr. Limotsi. You simply go, if you're using an Android phone, go to your App Store and download the Jikuze Android app, where with as little as 500 shillings, you'll be able to invest. Or if you're using your iPhone, you can go to your iOS and your App Store and download the Jikuze iOS, where you'll be able to register, move funds, and interact with us. So now I'll move over to Mr. Eric Asuma. Eric, the floor is yours with the closing remarks.
I will be very brief. Again, thanks Genghis for putting this together. I think it's time that I think we'll get the market on what's needed. I think all my panelists here, everyone is doing a fantastic job trying to educate the masses. And I believe there are so many opportunities generally on the NSE, so I think it's just a matter of how do we educate the public and make it easier for them to access the market. All in all, I think this should be a start of, I think, of a very long conversation, market stakeholders from the NSE, brokers, the regulators, in terms of how do we make it easier for the common man to access the market in a simple and seamless way. So I think this conversation should intend here. If there's a way to pick it up, to carry it forward and generally make some of these deliberations happen, I think it's a good time to pick it up. Once again, thanks a lot, and looking forward. Thanks.
Ms. Mbithe, your closing remarks before we get on to Q&A.
Fantastic. Thank you so much. I'm so excited to be part of this. And again, kudos to the Genghis Capital team. You can't keep talking about the retail investor. I think the retail investor now needs to talk to themselves and ask themselves, what will I do for the year 2021? I highly recommend, go and look at the Jikuze app. Go and download my NSE app so that you have more information. Second thing you want to do, it's the beginning of the year, the best time to be able to set out your goals for the next year. Take out a class, either take out a class with me or with my peers who also have financial literacy classes, and empower yourself and decide, what do I want to invest in? What do my goals need to be? As you're making those investment goals, whether you're investing globally or locally or in asset classes outside of shares, you need to have a strategy that says, I will allocate X% to the NSE. This is the reason why. In Kenya today, Safaricom, the largest company, generated revenues of 251 billion over the last financial year. Same company, we have people borrowing over 200 billion using Fuliza. So what that tells me is you and I are consuming, and we can afford to consume. What we need to do is to tweak that consumption and allocate part of our daily or monthly or regular consumption into equities for the long term. If you make a good buck in the medium term, perfect. But you really don't want the year 2030 to find you here and you have a consumption culture and not an investment culture. That's the narrative that we need to change. So looking out for tomorrow, talk to yourself, open that account, get acquainted with stocks, buy the stocks today and build wealth for yourself and future generations. Thank you so much, Kevin, and back to you.
Thank you very much, Mbithe. Mr. Thakar.
Thank you, Kevin. Well, my closing remarks would be in regard to investments and investing not being a passive exercise. It should be an active exercise. Even if you're investing 1,000 a month, you need to really put in the time. Say, for example, you have 2 free hours a day and you spend 1.5 hours with your family. take about 20, 30 minutes every day to read and consume material regarding this currently elite subject of investing. Join Twitter. Twitter is a place where you can get a lot of free information. I joined Twitter for free information. I don't want to pay subscription fees, but I know that that's a good option once I increase my net worth. So basically, I would say that, read newspapers, read articles, take some time to read the annual reports for the businesses that you have invested in or are prospects for you. Read more about the money market funds you put money in. Do a few Google searches on your broker. Okay, Genghis Capital will always give you good results, but also look at the companies you are investing in, their management. Google can give you the quality of a manager very fast. You can just Google your manager's name and you find that they won an award recently for empowerment of women, for example. And then, you start relating more with this manager and their management philosophy. So take some time, work on increasing that time you can allocate to even 2 hours a day if you are starting to take it very seriously now. Thank you so much, Kevin and Genghis Capital.
Thank you very much, Mr. Thakar. Over to Mr. Robert in just 10 seconds, because I have a question for each of you from our Q&A. Mr. Robert?
Thank you very much, Genghis and team, for organizing this. What I want to tell retail investors is that, first of all, try to understand the concept of capital. Once you understand that, then it will set you free. You'll be very interested in investing because capital creates abundance within a family, in an individual's life. It gives you some level of freedom. Even a country with more capital is more likely to handle situations such as COVID pandemic better. A family with more capital is likely to support their children to do business. If you have more capital, then you are likely to achieve your life goals. So it is that form of like a life partner that you need to be looking at. Because if you don't have it, then it means that you'll not live the life that you desire. So the first thing is to realize that you need that in future. Then you be patient, set aside part of your income that you earn on a regular basis, and know that over time, it is going to become more. So it is a journey. If you just start with 5,000 at the beginning of the year, at the end of the year, it is a lot of money, 60,000. So that way, over 10 years, it will be a lot more money because you have people who have worked like over 10 years, they're in a position where they could save just 10,000 Kenyan shillings per month. So that would be like over 1.2 million if remove without even looking at interest, but so many people don't have that. So if you can decide that you want this capital, it will help you to take your children to school, it will help you to start a business, then it is very easy to work backwards. Then you have a strong foundation and you are the one who is supposed to choose the investment options for yourself, not anyone else. Things that align to your personal value. So you normally hear people misleading each other that white people are not supporting our startups. Actually, the right thing to do is that let us save more, set money aside so that we have excess within family lineages. Companies can have more and support each other. We have the solutions within us. And I'm very happy that there are some diaspora communities like in Discord and several online platforms. They've now started investing even in local shares and US shares, and they're seeing that as an opportunity that we can use to build ourselves and become a bigger country. Become a bigger country by producing more and generating excess. And nothing else. It is as simple as that, really. Thank you.
Thank you very much, Robert. In the spirit of saving the best for last, Felix, if you may be kind enough to combine your last remarks by answering this question from our viewers, because Gay Dixon. January 2021, we have started to witness increase in inflation as well as government failure to start servicing debt. What is the impact of this on stocks, which is controlled by government?
Just before I answer that, maybe let me first start by telling investors out there that there are a lot of opportunities on the market. Investing takes patience. I always like giving an example of land because land is usually seen as the primary investment in our country. Most people at any point before they start investing on anything, they would benchmark with land. Before you buy land, you always have to do your due diligence. You'd go in to the lands registrar. You can go in and check if the title deed is valid. So that's just the same way you can invest. Before coming into the market, do your research, get to know who's handling what, just as most of the panelists have mentioned. You can check profiles for people, even if it's on the dealing firm, get to know which dealer is with that firm, what is the profile. I believe that would be handy. You build confidence on the market by building confidence in yourself. So that's a challenge that I would put out to every investor out there. Then there's the question about inflation coming in onto the market and how it's likely to affect government companies that are listed on the market. I think as much as most people always relate government performance to performance of companies that are listed on the market, maybe it's time when investors need to start understanding that the listed company has almost nil allegiance to the government. The only challenge that we have is that some of the appointees in the companies that are listed on these markets, companies that are listed on the NSE, some of these appointees, to put it on a blank note, these appointees are government appointees. And I know that is a major challenge to the retail investors. So I think for now, I believe with COVID-19 almost becoming something of the past, we're hoping that with the vaccine and everything else, we're likely to see a bit of positive economic turn over the next few months. I think that we're likely to see a bit of increase, not only on the market, but also on the general economic activity at large. So I think most of these companies are going to outperform the previous year. I believe it's going to be a positive turn. Though also don't forget to do your due diligence. Some of these companies are already on the red. They were on the red before COVID-19 came in. So we're likely to see them continue operating on the red, at least for the next few weeks. Thank you.
Thank you very much, Mr. Ochieng. Mr. Thakar, in 30 seconds or so, a question for you from Joshua Ndolo. Will we see increased liquidity in the NSE derivatives market next?
Well, I do not think that liquidity would increase unless we have more large-scale players take part in these instruments. Some of these investors are not speculators, so they would rather, allocate funds to the underlying stocks than to the derivative instruments. But the derivatives can give you huge returns because they are leveraged instruments. So the retail investors can start, speculating on them using technical analysis, as well as looking at the dates for earnings, dividends, things like that, and playing time, towards those dates. So that's an option, but we need to work on the liquidity first. It's the regulator and also the provider that need to find liquidity players, because that's what we have in Forex trading platforms. And that's why you can simply close a position at the touch of a button. So until that doesn't happen, I think it will be hard to attract people. But there's also the alternative of bringing in more instruments, like say the Kenya shilling against the US dollars, maize derivatives, innovative products like cryptocurrency. And yes, there are ways we can do this.
Thank you very much, Mr. Thakar. Over to our lady Mpithe Mwema in 30 seconds again, or less, as time is not on our side. There's a question here from Tetas Kinyui on one of our viewers. The world is in an era of low interest rates, and with the current global and local debt levels, we might have lower rates for a longer period. What challenges and benefits will these provide to investors? That's Tetas Kinyui.
Okay, thank you so much for that question. So aptly put, US rates, if you're investing in a 10-year, you're getting less than 1% return. But what is happening is there's also a level of arbitrage opportunity because you can easily access credit from diaspora markets and invest here for a higher return. But the point of caution, always know this, that you have to consider the cost of capital. You can borrow money and invest and not make a return. So be sure that you're comfortable to do that. But from a local perspective today, you have you have a plethora of investment opportunities, starting with the government of Kenya. The infrastructure bond that's currently open could come in at a return of 11.2%, give or take. That's a 16-year return. If you want to do long-term investing on the Nairobi Securities Exchange, there are good opportunities to buy blue chip companies for the long haul and hold them and target to get 15% return year on year going on. But with regards to interest rates, I think in Kenya, we expect a slight uptick just because of the nature of the environment and a liquidity crunch, and there are opportunities that abound here. Thank you, Kevin, and back to you.
Thank you very much, Mpipe, and thank you very much to all our panelists, Eric Asoma, Mr. Merthakar, Robert Ochieng, and Bithe Mwema. That concludes it for our panelists, the third panelist. Viewers, if you have any other questions, feel free to keep them coming. We're going to address them. My name is Kevin Maina again, Equities trader at Genghis Capital. Thank you very much.
Thank you so much, Kevin, for that informative and lively session as well that we've had about the landscape for the retail investor. And I hope that from wherever you're watching, you've taken in some of the takeouts. Amazing, most of them. I can even read two of what I've taken out. Number one, investing should always be active and not passive. So don't just throw in the cash and disappear. You want to constantly be checking out what things are happening and many more takeouts. But we can't end this entire session without saying asante in a particular way. And I want to request the CEO, Geoffrey Gangie, to be on set to give us the closing remarks and indeed thank us all. So when I see you, I think as he sets in, one more for you, that consumption culture versus the investment culture. Ask yourself the question, are you more of a consumer or an investor? I'll leave you with that to the CEO.
Thank you very much, Maina, for giving me this opportunity again. Ladies and gentlemen, you will agree with me that it's unfortunate that all good things do come to an end. And so we're going to wrap up what has been a half-day conference on the playbook. And I really want to say this has been a groundbreaking event for us, getting a mix of speakers from the government side, from the capital markets leadership, and also influential capital markets personalities who deal with clients and who are looking at opportunities on a day-to-day. I want to thank our speakers for the day, starting with our chief guest, Professor Dulacha Barito, who's a director at the National Treasury. We thank you for honoring our invitation today, and we were greatly humbled by your presence, representing the Principal Secretary. I also wish to thank the chairman of the Nairobi Securities Exchange, Mr. Kiprono Kitonyi, and the chairman of Genghis Capital Board, Mr. Godwin Mangungu, for their insightful presentations on this forum. We've had very interesting views, including contrarian views from our panelists, and this has enriched the body of knowledge for all our people who were on the conference. The presence, the participation, the critical examination of key issues affecting our economy and capital markets opportunities has enriched the knowledge of all the people who are on this call. And we will also make available the final playbook report together with the video of this session on our social media platforms, so that those who maybe were not able to join for the full duration can be able to see what other views were given. I want to say a big thank you to our clients for choosing Genghis Capital as your investment partner of choice. We genuinely appreciate your support over the years, and we hope you'll continue to with us in this journey of investment. To the webinar attendees, especially, this was groundbreaking for us, and I think we had probably more than 400 attendees at the conference. So again, changing the way things are done in the market has been one of the things that Genghis is very proud of from our DNA. We had very good feedback on the mobile app from some of the capital market participants, and we'll continue with that innovation because the journey towards investment must be made very, very simple. Simplicity is key, and we want to remain at the forefront of pioneering that. I want to recognize my fellow board members of Genghis Capital who are also on the webinar, the non-executives, Dr. Joshua Roni and Ms. Diana Gishaga, for their steady, thoughtful leadership and commitment to the firm, which continues to challenge us as management to drive this business forward and ensure that we're able to achieve the objectives of our clients at all time. I'm very proud of our research team for the work that they've done over the years. I think every week they come up with very interesting trading ideas, and many of you follow those ideas in your investment journey. I commend their dedication, and you'll agree with me many times, if not all times, they are absolutely spot on in most of the recommendations that they make. So very well done to the team, and may you continue the same spirit. I also want to acknowledge our marketing team led by Damaris, who have been working behind the scenes and driving the organization of this event, driving the numbers and keeping everyone on toes to ensure that the event is very successful, framing all the narratives for the day. And again, their professionalism stands out. Very well done to our marketing team. I don't want to go back to the views that have been presented because that would not do justice to the thoughts. But what I want to remind every investor out there today is there are two approaches to investing. And I think we focused a lot on the direct market investment, but also we have collective investment schemes. We have the Hela Imara Unit Trust Fund, and we have other unit trust funds. And it would be amazing to just note that in a year when COVID ravaged the whole economy in Kenya, based on the CMA report as at end of September, I think unit trust funds had grown by close to 20% year on year. We are probably going to touch about 90 billion in assets under management. 2 or 3 years ago, there was starting at about 40, 50 billion. And again, this is testament to the fact that there are investment professionals who can hold your hand and work with you on that investment journey. So if you feel that making the commitment to spend as much time as is required to become a market expert is too difficult, there are people who are gurus at this and who will make your money work for you. So let's pile more money into the unit trust products. I think they're great products and they're designed for retailer, for mass retail investors. And even the innovations around the Jikuza product were to ensure that for someone who didn't want to know what's the dividend yield and what's the price earning ratio, the return on equity, there's a very easy way for you to access those similar opportunities. And we continue to be available to help you support that. And yes, and I think with that, I just want to say a big thank you and reaffirm our commitment to continue to be your partner in terms of investment. We have a very strong team which has extensive experience in financial markets and across different products, be it corporate finance, be it asset management or securities trading and research. And this team is there to ensure that you achieve your financial objectives. Once again, thank you very much for your time and for your contributions today. And we hope to see you again at the next webinar. Have a great afternoon. Thank you.
Great, and thank you so much, Geoffrey. And I want to close the session now with just a couple of announcements. Number one is that there will be a comprehensive document with all the answers to the questions that you raised, courtesy of the research team and the marketing team as well. Second is to really thank you as well for your patience and being around for all those hours, but I know they were very useful hours to indeed plan for your year all across till December. And hopefully that the predictions that have been said will give you more information to make wise decisions when it comes to investments. The playbook as well will be available on all the social media handles, courtesy of Genghis. So you can visit their Facebook, their Twitter, as well as their website to get all this information, and specifically the playbook. And so to also let the media houses present, that the CEO and the research analysts led by Churchill will be available for Q&A sessions. From me is to say thank you so much for being here, and have a great afternoon as well. And remember, Genghis always have weekly webinars, so always follow them for more insights even as you go on your investment journey. Bye-bye for now. See you.